Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
First up, everyone, U.S. stock futures kicking off the start of the March trading here in the green ahead of a big week for earnings. Economic data and tariffs, that's on deck. And, of course, the S&P 500 starting the month barely in the green as we're taking a look at futures right now, holding up on those fractional gains. This after wiping out nearly all of its gains this year while global stocks have outperformed. Traders will be on watch for February non-farm payrolls, which will provide the latest insights into the health of the labor market and could fuel growth concerns. Meanwhile, investors bracing for the imposition of tariffs, which would be among the most sweeping of the Trump era, applying to a roughly $1.5 trillion to annual imports there.
Plus, a number of retail earnings reports are set to be released here this week, with the likes of Target, Costco, and Abercrombie set to report earnings. Now, investors will be looking for any signs of a slowdown here in the consumer, as recent confidence data showed a decline in sentiment.
And Bitcoin is fluctuating today after its rally lost some steam sparked by President Trump's latest announcement on strategic crypto reserves. The president announcing that the U.S. will include three lesser-known digital tokens, XRP, Solana, and Cardano, will be added to the digital asset stockpile. The announcement comes as his crypto czar, David Sachs, prepares to host the White House's first industry summit this Friday. U.S. stocks look to kick off the month in the green. Outside of retail earnings this week, the big focus for investors will be Friday's payrolls report and, of course, the imposition of tariffs. That's going to be in focus. There you're taking a look at some of the companies that are going to be reporting over the course of this week. The setup here coming into this specific part of the retail earnings season is with the backdrop of us already getting the largest retailers, both online e-commerce and Amazon, and us already having Walmart out. So some of these names have already moved on the results that we've seen come through from those names, namely Target here. But most notably, I'd be watching for any further revisions that we see lower on the EPS front based on some FactSet data. We've actually seen larger cuts to the average EPS estimates for S&P 500 companies for Q1. The average is actually higher than the 5-year average, the 10-year average, and 15-year average, and the 20-year average, according to the bottom-up EPS estimate recorded during the first 2 months of the first quarter here. So that's going to be in focus here, especially as we get some of those names that just flashed across the screen.
Yeah, it certainly will be. I think you're seeing a bit of a relief here across the street as we do lead up to the opening bell. Of course, this follows the sell-off that we saw on Friday. You're seeing also some buying here in gold following the steep sell-off that we saw last week. I think the market's very much on edge. You're starting to see that here, paying closer and closer attention to some of that uncertainty coming out of Washington. Obviously, the threat of tariffs could potentially here be a massive market-moving event were they to go into effect tomorrow. And then, of course, looking ahead to the other econ data that we're getting out later this week with jobs, any deterioration there, any signs of any weakening on the heels of some of that slowing growth here on the economy and some of the latest readings and estimates that we're getting out here for GDP going forward. I think that could be a concern here to the market as they try to figure out ultimately what that means there for the Fed, the timing here of their next policy move. But again, I think there is so much uncertainty. Earnings helping to offset that to a certain degree. But again, when you take a look at these numbers, we are starting to see some deterioration. I think that is starting to be reflected here in the broader markets.
You talk about the jobs data that we're going to get. This is going to be really critical for the mindset of the consumer. Thinking back to last week in the Consumer Conference Board, Consumer Confidence Index number that we got that actually decreased by 7 points during February to 98.3. Within that, you actually got a look at how consumers are thinking about, and their view is about the current labor market conditions. That weekend during the month, consumers became pessimistic about future business conditions, less optimistic about future income, pessimism about future employment prospects worsened and reached a 10-month high. So those all in consideration here, factoring into the consumer bullishness. And of course, that is something that will get a little bit of a read through once we get even more of the economic data on the labor market situation coming forward this week.
All right, let's talk about where Wall Street stands right now, because strategists are warning that the S&P 500's rally could struggle in the near term following recent volatility. Joining us now, we want to bring in Sam Stovall. He's CFRA's Research Chief Investment Strategist. Sam, it's great to have you back here on Yahoo Finance. So obviously, we're coming off a week here where the market did send some troubling signs. We are looking at some buying action here ahead of the open. Help us make sense of that recent volatility that we started to see creep into the market.
Sure. Well, good morning, Sean and Brad. Basically, I think the market has been worried about the Federal Reserve, about interest rates, and also inflation and the pressures that it is putting on consumer confidence. And also, we've been seeing, as you mentioned earlier, very good Q4 earnings, now expected to be up 16%, according to S&P Capital IQ consensus estimates versus the 8.7 initial estimate. But actually, that strength has been stealing from each of the 4 quarters in 2025. And instead of getting about a 12.5% growth rate expected for this calendar year, now it's down to about 9.5%. So, yeah, I think investors are a little concerned about the tariffs, what kind of an effect they will have on the economy and on inflation, and they're taking a wait-and-see attitude.
Sam, I wonder how you're evaluating a defensive play right now, because it seemed like, at least at the end of the last year, that defensive meant just go into technology because that was the long-term defensive play. But now you have some of those technology plays, Apple, Nvidia, they've led some of these larger declines as well to start off 2025 here. So where are you thinking about the defensive plays that make sense right now?
Well, in last week's note, I said that investors are like fainting goats. You sneak up behind them and whisper, bear market, and their legs freeze, they fall over and are aligned into the defensive areas, consumer staples, healthcare, real estate, utilities. Also, we saw a surge in bond prices, a decline in bond yields in a flight to safety. Because the PCE number came in along expectations, I think investors did breathe a little sigh of relief. We got a relief rally as a result. But I think investors are still cautious. The greed and fear index right now is in the extreme fear area. Maybe in a short term that could represent a nice buying opportunity. But I think investors are truly concerned. And as a result, they're focusing on those groups where the demand for the products and services remains fairly static.
Sam, what happens if the tariffs are implemented tomorrow?
Well, if they are implemented tomorrow, my belief is that they will be around for a very short time. I think they are still more rhetoric than reality in terms of negotiating. I think that the president, in his State of the Union address, will continue to take a hard line and will try to call victory in some ways, whether it relates to the border, whether it relates to tariffs, fentanyl, et cetera. But I definitely think that if we do end up erecting those tariffs, they will be brought down fairly quickly.
What areas of the market do you expect that to reflect some of the, even if they're just interim or not long-term left on the table, but ultimately a negotiating tactic that then gets implemented, but then there's some quick resolution? Which areas of the market would feel the hit, at least on the onset?
Well, I think it's those groups that were leading to the downside as the S&P 500 was reaching the precipice of a pullback or a 5% decline, which we approached in the latter part of February. So the more cyclical areas like industrials, materials, consumer discretionary, which do have a lot of international exposure or at least are sourcing a lot of their goods from overseas. Technology also, because of the question in terms of tariffs, with China and also whatever kind of reciprocal tariffs there could end up being. So it does seem the only semi-cyclical group that it seems to be above it all is financials, and they have really been driven more so by the insurance stocks.
So when you take a look at the fact that growth trouble seems to be forming a bit, is it too early for investors to start worrying about a greater slowdown and shall I even say recession at this point?
I think it's too early to talk about recession. Granted, the stock market does tend to peak anywhere from 8 to 7 months before the start of a recession, and the market tends to bottom 5 months before the end of the recession on average. So, as the old saying goes, prices do indeed lead fundamentals. So, the market's action will indicate how serious concern is regarding the health of the overall economy.
Sam, thanks so much for taking the time here with us pre-market. Good to see you.
My pleasure. Thanks.
Front of mind for investors this week are looming tariff deadlines with levies on Canada and Mexico set to take effect tomorrow, and the February jobs report that comes Friday. Joining us now to discuss, we've got Michael Reed, who is a U.S. economist at RBC Capital Markets. Great to have you here with us this morning.
Thanks for having me.
Certainly. So let's talk about the setup, kind of coming into both the employment situation side and then the inflationary side that we're going to see as the Fed is going to be paying attention to both what the administration does as well as what is coming through in the employment data. What do you think is taking priority for their thinking right now?
Yeah, I mean, it's a really tough situation for the Fed, to be honest. You have inflation that's still sticky, and what's going on right now with respect to the tariffs adds some risk that inflation stays around this 3% year-over-year pace. But then you think about what's happening on the labor market. You have job growth that is slowing. You have this added worry now that DOGE layoffs are impacting the broader labor market. So, that typically might be something the Fed may want to provide an insurance cut ahead of. But with inflation where it is, it just makes it very hard for them.
Michael, when it comes to tariffs, I guess the economic impact, I know you've run some modeling there. What do you think that looks like?
Yeah, so if we do see kind of these tariffs that Trump has described, 25% on Canada and Mexico, those are going to make it very hard for the North American economy. In fact, we've modeled on the Canada side, even at 3 months, that would push Canada into a recession if we saw tariffs implemented for that long. For the US, not necessarily as impactful, but still, we estimated it would slow growth basically to flat. So that is to say, we wouldn't necessarily enter a recession, but growth would be very sluggish.
Even without tariffs enacted right now, and of course this week is going to be the critical time marker for that and whether they get implemented or not, is it already having an impact that we can quantify from the consumer mindset side?
Yeah, so we're seeing some signs. I think you mentioned some earlier on the consumer confidence side. When you think about things like inflation expectations, those were quite elevated last week. And when you think about how that impacts consumer behavior, they may start to front run some of these tariffs. We saw some advanced trade report come out last week, showed there was a surge in goods that may be reflective of some of this front running. But I think more importantly, what we've been watching as it relates to the consumer is their ability to continue to spend at this pace. And what was concerning, I think, when you look at the details of the personal income spending report, it's that you had a notable pullback in January. You had real spending down 0.5 month over month. And we think that was payback for what we saw in December when consumer credit spiked. In fact, that was the largest increase in consumer credit in the series history. A lot of that came from revolving credit, which is reflective of credit card spending. So there you have to start worrying about, these folks, do they have the ability to continue spending? Are they going to load up on credit card debt and then worry about paying off the interest on that later? So these are some of the things that we're thinking about. On top of that too, when you look at the personal income side of things, that looked quite strong. But when you dig into the details, it wasn't the wage component that was driving the strength. And this is kind of adding to our narrative that we've been following and talking about in this kind of K-shaped economy. When you look at what drove the growth, it was things like dividend, rent, and proprietor's income, which are skewed more towards higher income households. When you talk about kind of middle class, most of those income gains rely on wage income. Those weren't as strong. So there, if you have a continued slowing in the labor market, wage growth isn't as strong, you just have a continued bifurcation in terms of the ability for the folks who are spending and using credit to pay that back. So at some point, they're going to have to decide, am I going to pay down my debt, or am I just going to pull back on consumption altogether?
So, Michael, how should we then be thinking about tariffs in that context? I guess just in terms of the inflationary pressure that they may cause and whether or not they're going to exacerbate some of those trends that you're already starting to see.
Yeah, it's hard to kind of quantify it in terms of the consumer, but one thing we do know is tariffs generally are disproportionately more burdensome on those middle and low income consumers. So you add on kind of this dynamic where already income growth is weaker for those households, and now they're going to face a higher burden of inflation on top of what we've already seen. In fact, we've been modeling this. When you think about some of the biggest drivers of inflation over the past couple of years, it's been things like shelter and food, and that has disproportionately impacted those same households. So this is just adding more inflation to those folks who are already struggling right now.
All right, Michael Reed, we appreciate you taking the time to join us here on Set today.
Thanks for having me.
Coming up next on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, we break down the latest in the crypto markets as President Trump announces new changes to strategic reserves. And Capri shares jump as Prada moves closer to purchasing the company. We got those details and more coming up next.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Kroger CEO Rodney McMullen resigning after an investigation into his personal conduct. The company says the personal conduct was unrelated to the business, but was inconsistent with its policy on business ethics. Lead director Ron Sargent was named chairman and interim CEO effective immediately. Mark Sutton is going to be serving as Kroger's lead independent director, and they expect full year identical sales without fuel to be at the high end of its guidance range. We also got that update in tandem with this release.
Yeah, limited details there just in terms of exactly what this does involve. But again, Ron Sargent was named chairman and interim CEO. And you take a look at his past, obviously, given the fact that he does have extensive experience. He's saying that he has been the director since 2006. He also formerly served as the CEO of Staples. But again, when you see a change at the top like this, we are looking at a bit of pressure here in Kroger shares. Year to date, you are looking at some gains here. But again, in a statement here to Yahoo Finance, and Kroger naming its interim CEO, Ron Sargent, saying, Quote, my decades here have given me a full appreciation of what makes Kroger unique. I plan to be a steady but active hand in the execution of our strategy. We'll see whether or not that alleviates some of the concerns, some of the unease that we did see creep up here in shares earlier this morning. But again, a change at the top, of course, just introduces some questions just in terms of the fact as to ultimately, as they do conduct this search for a new CEO, whether or not that strategy behind Kroger is going to change much, if at all.
We will see.
All right, let's take a look at Capri. Capri reportedly moving closer to selling its Italian luxury brand Versace to Prada. According to a Bloomberg report, the companies have agreed to a price of $1.6 billion. Now, this comes after Capri's planned $8.5 billion merger with Tapestry. That fell apart at the end of last year, back in November, after a judge backed the FTC's opposition here to that deal. You're looking at shares of Capri here up just about 8.6%. We'll see whether or not this goes through. But again, when you take a look at the fact that it looks like they have agreed on a price here, obviously a step here in the right direction. You are seeing Capri shares move to the upside, maybe some relief as to what the future, at least of part of this company, could potentially look like.
All the research I was doing on this story coming into today's show, all of my ad experiences online are going to be totally skewed towards the luxury end, things that I'm just not going to be able to purchase, and that's going to be sad for me. It's something I'll report back on, maybe not. But ultimately, one of the things here that we're also thinking through is just the environment that this is taking place within. You mentioned the deal that ultimately Capri had to move away from, and then now this potential for Versace to be brought on with Prada. This is considerable, especially knowing the larger luxury, state of luxury right now. Bain & Company had actually looked across some of the overall luxury spending that saw a slight decrease actually globally in 2024, speaking to, of course, the end of the consumer that still has more propensity or funds to and willingness to spend, but still, even among that consumer, there was a slight decrease. And specifically looking at the luxury goods market, the core of the core, as they call it, luxury segments, and the focus on analysis, actually, that saw its first contraction in 15 years. So that just going to show, even at the luxury end of the consumer mindset right now, how much of those discretionary dollars are even still being said within the household or at the individual level to say, you know what, maybe I don't need that new luxury handbag right now. I got another one. Or maybe I'll go get a fake one and just store the luxury.
Well,
one,
and the argument with Capri is that it's kind of in that middle ground, right?
Yeah.
It's not the ultra high end of the luxury goods, and that's why it has been struggling a little bit, especially when you take a look at one of its brands like Michael Kors. Obviously, it also owns Jimmy Choo, but when you come to some of its most recent results, or having a trouble here reviving some of that sales growth, the guidance that they gave didn't live up to the street's expectations, and we obviously have seen that weigh on the stock here. So investors very much hoping and looking for Capri to do something that would make sense, and at least for right now, it looks like they're a bit encouraged by what this could mean here for the company.
That was something that I learned this weekend, by the way.
What?
That people buy fake bags and then just store the real one somewhere else.
Saving it.
Look.
Could be a smart investment.
That might be my new strategy. We're also watching crypto stocks here today, taking a look at those big names after President Trump announced the creation of a strategic crypto reserve. This comes after Bitcoin dropped below $80,000 last week. Joining us now, we've got Andy Baer, who is the CoinDesk Managing Director. Andy, great to have you back here in studio with us. What does this mean for the crypto market broadly? This was campaigned on, this was expected. So is there any shock or surprise value to this?
First of all, how was your guys' weekend? Do you have a good weekend?
It's chilly, man.
We
It
don't have
was
weekends,
good.
so it's always nice to hear somebody
I'm
has a
loading up
weekend.
on fake handbags,
Yeah,
Andy.
no, I don't think we've had a weekend in 6 months. It was 10:24 yesterday morning. This first post on Truth Social came up with the president, and I think the big difference is that other tokens besides Bitcoin and Ether were mentioned as being eligible or as being attractive for a reserve. Solana, XRP, and Cardano. We actually have an index. These aren't arbitrarily picked. We have a large cap index. We call it CoinDesk 5, which actually includes those 5 assets in it, which supports better part of $1 billion in assets. So they aren't arbitrary names. They were a surprise to the market. The other interesting surprise was that the first social post failed to mention Bitcoin and Ether, and about an hour and a half later, the president said, "Oh yeah, Bitcoin and Ether also." So there was a little bit of concern in the meantime as people were sipping their Sunday morning coffee and looking. It's a great step forward in the last of a series of very crypto positive news in the United States.
And did you know how much is going to be bought or how it's going to be funded? I guess how should investors be thinking about that?
The details of this and what kind of congressional action would be required, all the details are way in the future. I think we're talking about an intent here. The president also, or the White House also announced that there would be on March 7th a crypto summit led by the crypto czar David Sachs and other folks. So I think a lot of the details might be hammered out there. But the idea that the government might reach beyond Bitcoin into a portfolio of digital assets, of important digital assets, and try to store things there is interesting. Just think about Bitcoin's almost a $2 trillion asset, right? So when you think about size, the smallest Cardano is only about 35 billion. So way smaller. So you have to think about scaling on a market cap basis. You'd have to have a lot more Bitcoin, a lot less Cardano. Yet Cardano was the biggest performer on yesterday's news.
So then skepticism surrounding this obviously makes a lot of sense, just given the lack of any of these types of details.
I think there is hesitation. I think, look, it was the first time I think that other assets had been mentioned. I think the idea that you would want to index what you're getting and not only get Bitcoin as a store of value, but actually invest in future of finance. Solana, Cardano, and Ethereum are all layer 1 smart contract blockchains, right? They really kind of support the applications which are going to change our lives in the future. So investing in that kind of technology, yet not particularly picking one winner in particular, I think is a good move. We, of course, love indexing. We're an indexing company, so we believe in that kind of style. So I think it's very positive. A summit that goes beyond Bitcoin shows that the United States, as the president said, wants to be the crypto capital of the world.
It's so interesting because I was reading through the Truth Social post that is well circulated now, and talking about us being a leader in holding and stockpiling of certain, and there it is on our screen for everybody who hasn't seen it, trying to make sure that this strategic reserve includes all these coins, but making America the crypto capital where we already hold the most Bitcoin. We already have, whether it's via seizures or just holdings right now, we have the largest stockpile. And so what extent will we need to see this be piled on top of for it to really make sense for those who were banking on some sort of massive move to the value of existing in circulation Bitcoin?
The bigger picture is these layer 1 smart contract blockchains really will support the applications that change our lives. Solana has been associated lately with meme coins, but has a lot of different potential. Cardano has potential. Ethereum is the biggest smart contract platform that has attracted banks and other financial institutions to participate. What we need to do is accelerate how blockchain technology can change how finance works, how consumer things works, how payments work, how a lot of things work, and having the government be overtly kind of supportive of this in terms of the summit, in terms of actually holding these things, just helps send a good message that this technology shift, which we still believe is on the same scale as the internet or mobile technology, is going to be supported, and is going to be supported overtly by the government. So I think whether the numbers and how much they're going to buy and how much that is going to support the price, that's kind of, it's interesting, but it's sort of, it's window dressing. The real idea here is to become the crypto capital of the world. We want to advance these technologies forward.
Andy, thanks so much for taking the time here with us today. Look, I'm wrapping my head around all of it. So I just got ChatGPT
changing by the
over
hour.
weekend. Yeah, a lot of stuff going on. All right, Andy, appreciate it. Coming up, we'll count you down to the opening bell on Wall Street. Stay tuned. Welcome back. You're taking a live look at the opening bell on Wall Street and in Midtown Manhattan, where you've got Euphoria, not to be confused with popular hit show Euphoria. Euphoria ringing the opening bell at the NASDAQ with some funfetti in the air, and Citi ringing the opening bell at the New York Stock Exchange, kicking off Women's History Month here in March. All right, taking a look at the major averages as we begin today's trading activity. The Dow Jones Industrial Average up by about 0.2%. The NASDAQ Composite, that starts off higher by about 0.4%. We'll round that off too. And the S&P 500 up by about 0.25% to begin today's trading activity. I want to just zoom on over to some of the sector activity and hustle with my time that I have here towards some of the leaders and laggards. The laggards right now on a sector basis, staples pulling up the caboose. We do have more leaders than laggards, though far more. And materials is leading that pack. It's up by about 0.9%. Host of other names seeing some fractional gains here out the gate this morning. Let's take a look at the NASDAQ 100 right now. If we were to put the entire composite up on here, you would be squinting like nobody's business. All right, taking a look at some of those mega cap tech stocks. You're seeing Apple trying to find its footing out of the gate here this morning, oscillating between gains and losses. Google right now, Alphabet, whatever you call them, calling them up here right now by about 0.8% in the green. Meta also seeing fractional gains. Amazon higher to start off today's session. Nvidia, though, that is down by about 1.7%. I was taking a look at this year-to-date chart here just while we were having one of our conversations with guest Sam Stovall of CFRA a little bit ago, and I mentioned Nvidia. I wanted to check in on Nvidia. Year-to-date, still down by about 8.5%, so we'll continue to keep tabs on that one. That company just reported earnings last week. And then lastly here, let's just take a quick look at the Dow 30 components to begin today's trading activity. It looks like we have more gainers than laggards right now. Boeing, that's leading the pack. That's up by about 1.2% to kick off today's trading. And then additionally, Nike here up, as well as Honeywell, I believe, as well. That's up by about 1.3%. Those leaders being jousted over as of right now. But the laggards, still Nvidia. Jared, let's get on over to you with a deeper dive on what's taking place out the gate this morning.
Thank you, Brad. Just a quick reminder, we are coming off the best day for the NASDAQ 100, the Dow, and the S&P 500 since January. I'm going to put a year-to-date chart. Here's the S&P 500. You can see we just dipped into the negative at the very tail end of February, but we are now back in positive territory for the year. Here is the NASDAQ still looking at year-to-date losses, so we'll have to see what comes of March. As I outlined last week in a couple places, I have two different models for March, and one of them is a little bit higher, one of them is a little bit lower at the end of the month, but April is when we typically see the big rally that we like to see, at least for the bulls. Here's a 10-year T-note yield. This is also year-to-date, not doing a whole lot. It's up 1 basis point. The movement today is in the dollar. A lot of times these two assets move in tandem, and today it's just the dollar. That's down 2.4% year-to-date. That is generally speaking, that is a tailwind for risk assets, and it looks like that's what's happening today, this continuation rally off of Friday's good fortune. And today we had tech and cyclical stocks leading in the early going. That was pre-market. Now it is mainly materials and industrials, so that's a cyclical component there. But I wanted to take a quick look at financials. Here's a year-to-date look at financials. That should be good enough. Yeah, 52.26 was the prior record high, so that is a fresh intraday record high for financials, and you can see they're up 8.2% this year, and some of that's deregulation, some of that is just the cyclical rally that we've seen here, and maybe a little value thrown in. Want to get to the NASDAQ 100, where we see Tesla continuing its gains from Friday. Here's the year-to-date too. That's down, Tesla's still down 25%. But critically, this low that we had on Friday, that was right off of the 200-day moving average. That's a key technical level, and that means the bulls are still in control long-term. The short-term is still down, but long-term bulls are retaining that edge. So we'll see if we get any continuation off of that. And we're seeing a lot of movement in the metals today. Not huge, but for instance, palladium here, that just caught my eye. That's up 4.6%, platinum too. But silver is what I was looking at, that other industrial metal. Here's the year-to-date up 9%. Silver having its biggest rally today since January. It's up almost 3% today. And then gold and copper are jumping as well. I'll show gold because that has been hitting records this year, although not within the last few weeks. It has found support here, maybe off of 2,800 or so, and you can see just shy of 2,900. 3,000 is a big number. hasn't reached it yet, at least not priced in US dollars, but we'll see what the cards hold for March. I'm going to be doing a deep dive into gold in a few minutes here. Finally, I'm going to leave you with crypto. Bitcoin up 8.7%. This is a 20% jump off of that low, and there's another 200-day moving average story. So is Bitcoin in the clear? Not quite yet, but if it manages to squeeze above 100,000, that's 8,000 higher. If it manages to squeeze above that, I would say the longs are firmly back in control there. Shauna?
We'll see how this all plays out. All right, Jared, great stuff. Thanks. So now for today's strategy session. Now this year's market volatility mirroring what we saw at the start of last year. And according to our next guest, each sell-off then offered investors a rewarding entry point. Joining us now is Adam Johnson. He's Bullseye American Ingenuity Fund Portfolio Manager. Adam, it's great to have you here.
Likewise.
At the desk. So is that going to be the case this time around too, you think?
Yeah, and I think that's what we're seeing today. It's amazing to think that over the previous 10 sessions, the NASDAQ was down almost 10%, right? I mean, just day after day, and I kept looking at my screen and saying, yep, we're down again. And yet, that's exactly what we saw on 3 occasions last year. Each was a wonderful buying opportunity. In the moment, it never feels good, and I get calls from clients and they say, I mean, is this it? Is it over? No, it's not over. Nvidia, actually, as much as the NASDAQ went down last year 3 times, Nvidia went down even more, 30%. 3 times, and each time it came back. So I think you have to take the long view.
And so a lot of people have taken that long view, and long Mag 7 is the most overcrowded trade we know right now, essentially over the past 2 years. So where else are there opportunities to maybe outperform, especially knowing the pullback that we've seen in some of those overcrowded trades?
Well, I think what you're getting at is something that was impressed upon me by an early mentor. And he would ask every time someone went to interview with him, he would ask one question. And the question was, how do you make the most amount of money on Wall Street? And the answer that got you the job was find a theme and leverage it. AI is the most powerful theme in the market right now. We're all talking about it. I don't have to explain to you or to anybody why it matters, right? Just as every company became an e-commerce company 15 years ago and then a cloud company 10 years ago, now every company is becoming an AI company. So leveraging that theme is a very powerful way to make money. Nvidia became the obvious one. Stock's up tenfold because earnings are up tenfold. And then you start thinking about what AI requires. Data centers. Again, something we're all talking about. So you could actually put together an entire portfolio just around data centers. GE Vernova, ticker GE, which uses nat gas to produce electricity on site. That powers the data centers. Sterling Infrastructure, STRL, actually builds the data center themselves. Supermicro, a company we've been talking about that got crushed, now trading at 10 or 11 times earnings. They assemble the AI infrastructure that you need to actually become that AI company that they all want to be. So, if you want to talk about where to go that's outside the Mag 7 but still kind of related, I'd go to AI and data centers.
Adam, how should investors be thinking about that valuation aspect to this? Because I think that is a huge question, especially when it comes to some of these AI names. And obviously, it's a very stock pickers type of market right now, as many would argue. But clearly, that story and that narrative changes depending on who you're talking about.
Well, the way I think about it is the price you pay for the growth you get. So, for example, you can buy the S&P 500. It's trading 21 times earnings, and you get 12% growth. Okay, fair point. That's our sort of benchmark. Well, you could go out and buy Nvidia, trades at 30 times. You say, oh, that's a lot more than 21. Yeah, but it's growing at 60%. Supermicro, trading at 10 or 11 times earnings, growing at 60%. So you say to yourself, well, what am I willing to pay for the growth I'm getting? By contrast, Palantir, which I will not touch, I wish I had at $8, I didn't, now trades at somewhere around 180 times earnings. Really? With 15% growth? So you're gonna pay however many more times that is than the S&P 500, 7 or 8 times more than what you'd pay for the S&P 500 for marginally more growth? That doesn't make any sense to me.
Where do you think is the state of the growth narrative for companies right now, especially knowing that with the amount of the earnings season we've moved through, the revisions, and it's not atypical to see in the first quarter revisions to some of the full year outlooks, but we've gotten more revisions to the downside than normal, even during this period.
Yeah, we have, and yet the growth that companies put up in the fourth quarter was 12%. Actually, I think 12.3. And the margins, critically, profit margins were 13%. That combo, 12.3% growth, 13% profit margins, that's the best we've seen since 2021. You know, that acceleration coming out of COVID. And while, yes, you're right, guidance has disappointed some, I would say, that's a fair characterization. We're still talking about 13% growth, which is better than the 12.3. So, you know, it's very popular to sound skeptical. Bears always sound smarter than bulls. You know, people just assume that the bears see something that the rest of us don't. But in this case, I don't agree with that. You know, just take it at face value, don't overthink it. Market down 10% on the heels of 12.3% growth with 13% growth likely for the next reporting season. Buy it.
Yeah. No bears or bulls on this desk, just eagles, ultimately. Adam, thanks so much.
Oh, thanks for having me.
Thank you.
Good to see you. Time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at an economic indicator flashing a warning sign. Hey, Maddie.
Hey, Brad, that's right. The U.S. economy on track for negative GDP growth in the first quarter. That's according to the latest Atlanta Fed GDP Now forecast. You can see here that huge drop-off in indications of where we are heading for that GDP number for the first quarter. And just to broaden this out a little bit here, this is the lowest reading that we have gotten in the last decade ex-COVID. So definitely flashing that warning signal. But in order to not freak people out too much, let's talk about what goes into this number. So a huge drag on this number this month was in the form of companies preparing for tariffs. We saw a huge drag on net exports as companies are holding on to inventory. That weighed on this number a lot, but we also saw consumer spending dipping, and that weighed on this number a little bit too, not as significantly. So the question is this tariff noise or is this something more sinister? That's something that we're going to be continuing to talk to our sources on the shows a lot about throughout the course of this week. If it is something more sinister, if it is consumer spending that is weighing on this number, that could be a concern, particularly in retail earnings week, which we are heading into now, and something that we will hopefully get more color on as we hear from those companies. Also, lastly, want to mention one of the reasons that we take a look at this is because 2 quarters of negative GDP growth plus a lift in unemployment, that is the formula for a recession. So again, just a warning sign, but something to continue to monitor.
Certainly something to watch here. All right, Maddie, thanks so much. Coming up, we're taking a look at the state of retail ahead of a very busy week of earnings. We've got that for you when we come back. A busy week ahead for retail earnings. Target, Costco, Macy's, Best Buy, many more are set to report their results. And this comes as the latest read on inflation showed that consumer spending actually fell just a bit, and this came despite moderating price increases. Joining us now with his read on the sector at large and the consumer, we want to bring in Jerry Storch. He's the CEO of Storch Advisors. Jerry, it's great to talk to you. So I think the big question here for so many investors is whether or not we've seen a peak in the consumer and whether or not that picture, the macro picture, is starting to deteriorate just a little bit. What do you think?
Well, I think the consumer has been struggling for some time. Debt levels are all-time high levels. As you know, inflation has been weighing on consumers. There was a burst of optimism following the election. Even people who didn't back President Trump thought he might be better on the economy than what we've seen for a very long time. But what we really see is nothing's changing. And even though I see that data where we say, February or something was down versus the prior month, it was up about the same amount year over year, if you look at retail sales, as it's been every other month in that kind of 3%, 4% at the best month kind of a range. So I don't think it's necessarily slowing down, but I think we have just so much time for optimism to last until people are going to say, what's going on here? Nothing's changing.
Yeah, and Jerry, I mean, and households are continuing to need to outlast some of the elevated expenses that they're seeing in housing and utilities, as evidenced in the most recent personal income outlay here, and PCE, I should say, as it's more colloquially and commonly known. At the end of the day, when you have that extent of consumers that are feeling pressure on the things that they need to purchase versus the wants, what are the retailers that you would be most looking out for the wants category to take a serious hit?
Yeah, well, look, I agree with your diagnosis, by the way. And so consumers are, everyone says, oh, consumers still spending. Well, most of the spending is on things they have to buy, like rent, healthcare, and then required purchases like at Costco, Walmart, things that are consumables, groceries, value. So therefore, by contrast, the people you expect to suffer are people like Target, for example, who really has not been doing as well as Walmart for quite some time because they rely more on products that you don't have to buy that are more discretionary in nature. Same thing for department stores as a group. For specialty apparel, there can always be some winners who have really hot products. But if you look at the category as a whole, that's going to continue to struggle. So it's the discretionary purchases that suffer in this kind of environment.
So, Jerry, I guess the downside or what that potentially looks like here this earnings season, how much of that has already been baked in, do you think?
I think most of what happened over the holidays, people know. Yeah. There's no real surprise, about who had a good holiday and who didn't. The question is going to be what kind of guidance are we going to see? And most of the guidance we've seen from retailers has been fairly conservative. And the question is that them just being smart? Because obviously in this environment, who would be crazy enough to guide, wildly optimistically, or in fact, do they have reasons for believing it's going to be a very tough year? And I think it's probably a little bit of both. Things are not ebullient right now. There's no doubt about it. So it would be nutso to come out with very high guidance right now, and I don't expect to see it from anybody.
So what do you think just the tariff impact is going to look like? As you, obviously, the experience that you do have, executives trying to navigate this very uncertain environment, how are they then factoring that in here for the quarters to come?
Look, people don't know. We don't even know what tariffs we're really going to see yet, and certainly don't know the impact. I will say my own belief is that the sky is not falling. When we look at the tariffs that President Trump imposed in his first term, they didn't have kind of a draconian effect on the categories that are affected on the economy as a whole. And there were some fairly significant tariffs during that period. But what we saw is most of the costs were indeed sort of muted through negotiations with suppliers. Now we're adding on top of that, and so it'll be harder to pass as much of that along, but some of it will stay with suppliers. Some of it will be substituted for other products. Some will be produced in different countries. The one thing I know for sure, let's say they say it's a 20% tariff. That's not 20%, keep in mind, on the retail price. That's 20% on the import cost, which is only a portion of that. So it won't be quite as high as kind of the sky is falling scenarios. But in some businesses, take auto parts or something where there aren't clear substitutes, I think you're going to have problems. A lot of consumer goods, there are substitutes. It won't be quite that bad. And so I guess I don't think the sky's falling. It wasn't as bad as people thought it was going to be last time. I don't think, whatever it is, we don't even know yet. I don't think it's as bad as people think now.
What are the keys to the trade for retail right now from your perspective?
Well, I'm still sticking with quality. I know, that people believe that maybe Costco is overvalued now. They've done too well. Same thing with Walmart. I mean, Walmart, for gosh sakes, is up 68% on a 52-week basis. Can you believe that? Walmart is up like that, or TJX is way up, or Amazon is way up. But I know they're going to perform fine. The question's going to be, is the valuation too rich right now after everything that we've seen over the past year? And I'd still rather be with quality than go after somebody who's, kind of in trouble in this kind of environment and grasping for life preservers, and it may turn out to be an anchor. So I'd still stick with those folks who have been performing really, really well for a long time, not because the upside's so huge, but because the downside probably isn't.
All right, well, fortunately, I've got my floaties. Jerry, thanks so much for taking the time.
My pleasure.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, Southwest Airlines downgraded to underweight from neutral at JP Morgan. Analysts warned in a note that less government travel and cautious consumer spending could impact Southwest and other airlines in the months to come. The stock's price target was left unchanged at $25. Shares are lower by about 0.4%.
Plus, it could be a good time to buy Chipotle. That's according to a new note out from Morgan Stanley. They upgraded the stock to overweight from equal weight, calling the company a, quote, quality large cap growth compounder that's been weighed down by short-term headwinds. Now, analysts expect the company's catalysts are going to boost performance in the months ahead.
And finally, a tale of two ratings for Deere. The farm equipment maker was added to Goldman Sachs' conviction list. Analysts believing the stock's sluggish performance is headed for a turnaround, and now's the time to enter. But Baird analysts see it differently. They downgraded Deere to hold, saying the timing of recovery isn't certain thanks to weak commodity prices and tariff uncertainty.
All right, well, that does it for Morning Brief, but keep it right here on Yahoo Finance. Catalyst is coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts that are moving the markets this hour.
First up, we break down the market outlook for March as investors await key earnings, economic data, and more.
Plus, we're going to dig into the data and get a preview of what we can expect from February's payrolls report later this week.
And we'll look at how tariffs could impact the economy, consumer prices, and sentiment, with sweeping levies set to go into effect tomorrow.
Let's take a look at some of the market headlines to start the hour, sponsored by Tasty Trade. Taking a look at the major averages right now as we do digest the U.S. ISM manufacturing data, the fact that it fell, the prices paid rising during the month, obviously having a bit of an impact here. You're looking at all three of the major averages now in negative territory. You've got the S&P off just about 0.4%, the Dow just below the flat line, the NASDAQ adding to earlier losses, now off just about 0.8%. So again, when you take a look at some of that pressure that we are seeing return to the broader market, flipping over to the bond market there, taking a look at yields, that has been a huge mover here. You got yields moving to the upside, up just about 1 basis point, not a huge move there, but still right below that 425 level. And flipping over to Bitcoin, lots of action in the crypto markets following the news on Truth Social over the weekend, further digesting, looking ahead to the crypto summit as well. That's going to happen on Friday. You're looking at Bitcoin rising off the highs of the day, but still up just about 5% here today, just below 90,000.
Yeah, and it looks like the market's still holding on to gains as we're digesting that economic data amid broader concerns about economic growth. All eyes, of course, on Friday's jobs report for the latest insight into the consumer. Our very own Josh Schaefer on set with us for more. And Josh, it's obviously interesting looking at that prices paid number surprising to the upside. What does that tell you about the concern that's starting to enter the room about the economy and whether or not that's kind of a flash in the pan or something more sinister?
Yeah, Maddie, I think when we get to the point where a prices paid print in an ISM reading is moving the market this much, that's usually when you can get to the point where you're saying, okay, the market is skittish on every piece of economic data, right? Because prices paid in this ISM data for the manufacturing sector would, in theory, be a read-through into potential inflationary pressures, right? That's sort of the takeaway why people would be concerned about that. But it's not a actual inflation reading, right? This isn't the Fed's preferred inflation gauge we were looking at last week. This is perhaps more of an indicator of where prices could head. But there's a clear read-through right now over the past month, really, at this point, has been markets are worried about inflation maybe being higher than we thought or stickier than we thought, stickier than we hoped, and the economic growth story not being as strong as many investors had hoped for coming into this year. Even looking at the ISM manufacturing number itself, the index came down to 50.3, right? So it had just entered expansion territory last month, already starting to come down. You wonder how bad the trajectory is there when you look at another data set, S&P Global. They noted that, yes, the number itself went up for S&P Global, but the commentary, a lot of businesses concerned about the overall administration and policy. So clear market reaction here has been bad economic news, not good for stocks. We're looking for good economic news again, and that's sort of the narrative, I think, heading into Friday.
Yeah, and Josh, just building on top of that, given the fact that the NASDAQ had been up 0.8%, ahead of this report, now we're looking at losses of just about 0.8% there. What does that tell us just about how much uncertainty there currently is right now, and how much, I guess, uncertainty might be the best way to put it, but indecisiveness just in terms of the direction and the economic story and how that's going to play into some potentially handicapping some of the gains that we're
Yeah, I mean, it feels like people have been looking for a little bit of a reason to sell, right? You're at pretty extended levels, or you were at pretty extended levels going back a couple weeks ago for the S&P 500. We know valuations are as high as they've been over the past several decades, right? And so when you get to that point, you're kind of wondering what could make me sell here, right? And it's been this economic data and a little bit of concern. Also, we haven't even talked about tariffs yet, right? And that's supposed to come tomorrow, or we're going to get more news on that tomorrow. And so there's just a lot of these little pieces sort of coming in, and the overall read has not been that positive. But I think some people have sort of been pointing out to you guys on the show, and Maddie, I know you were talking about this with Neil Dutta over at RenMac. The stocks that are selling off is also interesting too, right? We're looking at a little bit of an unwinding of the momentum trade. If a stock like Palantir that had been up over 100% starts coming down a little bit and it all is happening at the same time, is that really a growth scare trade? Or is that people getting out of an extended name? And I think you could perhaps maybe argue the latter, right? But right now, what the data is sort of showing us is it's extrapolating the skittishness that you're seeing across the market and is expected to come again on Friday with that big jobs report. Seems like we're probably going to get one of the bigger moves we've had in a while off of payrolls.
I think it's also really interesting, the context of what we're talking about, again, seeing this sell-off off of this print. It tells me a little bit that the market is more concerned about the economic data right now than tariffs, because we have seen tariff announcements moving individual names, but not necessarily dragging the entire market down with it. And I know you've been following investor reaction to those tariffs. Does it seem like the focus is that econ data?
It feels like right now the focus is the econ data, because it feels like the consensus from strategists on what is going to happen with tariffs is that we're not going to get full 25% tariffs on Mexico and Canada. Most strategists are still telling us that is probably not priced into the market at this point. And if it is believed to happen, it's believed to be short-lived, right? That's sort of the consensus stance right now, is we are not going to be sitting here in June still talking about the 25% tariffs that were put on Mexico and Canada. That is not how people feel this is going to go. So the opposite of that would be, well, if that's what's priced in, the bad news that could come tomorrow would be we do get 25% tariffs and it doesn't feel like they're going anywhere, right? What do we hear about negotiations? Are they really just a negotiating tactic? If not, then maybe you start to see tariffs take a little bit of the lead, Maddie, and that's also a key market driver overall.
Yeah. All right, Josh, thanks so much. Well, ISM data coming in this morning disappointing to the downside ahead of that key jobs report on Friday. This comes after data in February showed some signs of continued softening across the U.S. economy. Joining us now to discuss is Michael Gapin. He's the chief U.S. economist at Morgan Stanley. Michael, it's great to have you back here on the show. So talk to me just about how you are sifting through some of these conflicting reports, especially those that are showing maybe the fact that the U.S. economy is starting to weaken just a bit.
You know, it's always difficult in these moments, but I think right now most of the data suggests that we're getting payback from a very strong fourth quarter, right? The biggest signal we've seen so far is that spending on durables retraced pretty sharply in January. Remember, auto sales were almost 17 million units on an annualized basis in December. So I think really there was a short-term demand for cars following the hurricanes last fall, and that should pay back. And it seems like it's paying back in the first quarter. So that, I think, is the majority of the story, payback, not turning point. But I think the ISM data that just came in does give you a little bit of an imprint of what tariffs and trade restrictions may do, right? So if that above 50 reading is driven by the prices paid component, remember back to COVID, higher prices paid pushed the headline on these indices higher, but these are indices constructed around demand side forces that would normally read stronger prices as stronger demand, pushing up producer prices, and that's not the case, of course, in this instance, right? So there's hints of tariffs would weaken both employment and activity by pushing up prices paid, and that's a soft data indicator. We have to see if it flows through into the hard data. So again, right now, I'd say payback more than turning point, but we have to be aware and alert for the turning point.
So Michael, what does that potential turning point look like, and how are you looking at the incoming data versus the incoming policy news out of Washington and sussing out which of those two buckets is going to be that turning point?
Right. So I guess when I say turning point, I'm kind of thinking, recession risk. And right now, I think the outlook is, manufacturing is a relatively small portion of the U.S. economy. It's about 10% of activity, 10% of employment. Trades, maybe let's call it 15% of GDP. There's a lot of overlap there between trade and manufacturing. So it's really, we're talking about a general slowdown in growth towards, something maybe to the 1.5% to 2% range from the 2.5% to 3% that we've been doing. So it's not, we're not saying that this is a recession, but if you put on trade restrictions, immigration restrictions, you try and act some spending cuts, it seems like the edge off the economy should be taken off and growth should moderate. So turning point here, I'm saying, what would be the recession scenario? And you need spillover from the good side of the economy into services. That probably comes through very weak asset markets, which would mean that upper income consumer, which has been spending and driving the recovery, would decide, hey, maybe we need to spend less and save more. So I think that would be your channel. Too much volatility, a big correction in equity markets, that might cause consumers to take a step back.
Michael, I guess, is there a higher probability or chance of that happening at this point, do you think, when you're taking a look at the data?
Sure. I given just the sheer amount of change across a number of policies, whether it's, again, trade, immigration, fiscal policy, geopolitics is an issue again. So there's a number of things here that could, and I emphasize could, we're not calling for it, that could collide together in a way that leads to risk-off sentiment. You get whiffs of it now and then. Again, our baseline is a moderation in the economy, a continued recovery in the economy, but we have to be watching out for signs that, the combination of policy choices and heightened uncertainty lead to a greater pullback in activity than we expect.
Michael, you mentioned that personal spending for the top 10% of earners. They're responsible for half of U.S. consumer spending right now, according to Moody's. Do you think that makes the headline data look better than it actually is? Do we have the accurate data to suss out the health of the economy right now if that data is being held up by the top 10% of earners?
I do think we have the accurate data, right? So again, as an economist, we're writing down aggregate consumption, total growth in the economy, overall inflation. What you're pointing to is there appears to be, a wide distribution of where, households are seeing income growth or wealth growth and what that means for consumption. I think, the way I would put it is, the health of the economy or the robustness and the durability of the recovery is driven by a smaller and smaller share of households. That's not necessarily bad from a propagating the recovery point of view. But again, those are, as we're alluding to here, those are upper income households that hold the majority of the financial and real estate wealth in the economy. So what that's saying is the major risk to the recovery is if all of this policy uncertainty collides in a way where equities say, we're 20% overvalued and we need a big correction. If you got that kind of correction, then upper income households aren't spending, the economy and the labor market weakens, and that's a very different story. So that's how I would interpret it.
Michael, one of the notes that you published a couple weeks ago at this point was titled Immigration and the Macroeconomy. And it caught my attention just because you mentioned the fact that obviously there's so much talk and rhetoric and focus going on when it comes to tariffs, that immigration is also potentially very consequential to the U.S. economy. I guess more specifically, what does that potentially look like, and what should investors keep in mind, especially as we head into the jobs report?
Yeah, I think that the story here is that tariffs get all the headlines and they're the bright, shiny objects in the in the news flow right now, and for all the reasons I think are right and we understand. But we're just trying to emphasize here that, remember, in the background is a very strong desire to control immigration flows that actually started in the middle of last year when the Biden administration took steps to control the border flow. Now, so I think we all agree that coming out of COVID, the surge in immigration put upward pressure on economic activity and brought in a lot more labor supply. So it took the economy to 2.5% to 3% growth, but also helped wage growth to come down and inflation to come down. So the supply side component here was very important. If we restrict immigration, go from roughly 3 million a year, like we had for 3 straight years, back to a million or less, something kind of below our pre-COVID averages, well, then shouldn't that narrative reverse? You have fewer spenders, fewer labor suppliers in the economy. So I think it can take immigration alone could take the economy from the 2.5% to 3% growth rates that we've seen in previous years, take it back down towards 2 or maybe even 1.5 if the combination of restricted inflows, some increased deportations, and maybe a chilling effect on labor force participation weighs on the foreign born workforce. So I think we're just flagging that as, hey, don't forget, immigration is working under the hood right now. It's going to be harder to see in real time, but it should mean less growth in the labor force, less consuming households, and that will also pull growth lower.
So, Michael, I guess to put a bow on everything that we have talked about so far, it sounds like recession risks could weigh on asset prices, and if there's a sell-off to an intense degree in asset prices, then that could cause a recession. Can you help me understand the kind of feedback loop between those two things and which domino falls first to cause a substantial economic risk?
Yeah, so that's exactly right. And so the baseline view would be, well, trade restrictions, immigration restrictions, that should mean a slower growth, stickier inflation outlook, a Fed that cuts but cuts later. So the baseline isn't a recession, it's just a moderation in activity. But the risk is somewhere in here, maybe we push the policy levers too far. There's too much policy uncertainty, or it weighs on growth and employment more than we think. Then you get a stronger asset market correction and you get the reinforcing mechanism to lower consumption and recessionary outcomes. So it'd be more, at some point we've gone too far, asset markets correct, consumer takes a step back. Again, that's not the baseline, but that's the downside risk as we would see it.
All right, Michael, great insight as always. Thanks so much for taking the time to join us here this morning. Well, coming up next, we're going to take a look at some of today's top trending tickers. First up, why Tesla is climbing higher after a tough week for the stock. That's coming up next on Catalysts.
Gold ETF flows hit a record last week at $5 billion, and a closer look at the longer-term trend may point to more upward momentum for the yellow metal. I'm Jared Blicker, your host of Stocks in Translation. Let's take a look at gold's record inflows and why the move may just be getting started. First, I want to go to a gold chart. This is going to be a 10-year chart of price action. You can see we're at 28.93 right here, and we've got two big rallies that we saw. One was in 2019 to the early part of 2020, and the other was last year. 2024 just took off, and it's continuing to make record highs this year. But let's take a look. We're going to get to ETF flows in a second. I want to take a look at what central banks have been doing, because they have been the biggest marginal purchase of gold in the last few years, arguably going back to the last decade. What you can see here in each of these last three bars, that's 22, 23, 24, those purchases basically doubled the prior average, and we're now looking at about 1,100, at least over 1,000 tons per year. Simply a huge amount, and it dwarfs anything that we're seeing in the ETFs. However, very recently, over the last 5 days, we have seen ETF buying just explode to the upside, and here we have this bar. This goes all the way back to 2019. So even during that 2019 rally, even in that 2024 rally, we saw nothing approaching the flows that we saw last week alone. And now I want to put this in the context of what happened over the last 6 months. So this same chart that we were looking at, if you spread out that buying from 5 days to 6 months, you get a longer term view. And you can see here we had the peak in early 2020. That was just before the pandemic, when we had that huge deflationary impulse that affected all risk assets. But ETF flows over the 6 months on that basis were much, much higher, approaching $30 billion. What we're seeing now is just a blip on that. So my thesis is, if we see anything approaching the prior run-up, or the prior run-up in flows that accompanied that rally that we saw saw in 2019, we should have that much more incremental momentum for the price of gold finally launching above 3,000. And that's pretty much how I see gold right now. Back to you guys.
Jared, thank you so much. Appreciate it. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Tesla reinstated as a top pick in the U.S. auto space by Morgan Stanley. Yahoo Finance's Praz Subramanian is here with more. Praz, I love the way they start out this note. Tesla shares down 30% year to date. It's our top pick in U.S. autos. Explain.
Yeah, I mean, it's more of the same here from Jonas, right? Last year was also, it was his top pick, but it's more about the autonomous and the AI opportunity with Tesla, not so much the actual auto business here, right? Or as he calls it, embodied AI. We're talking about robo-taxis in cars. We're going to start that new robo-taxi testing in Texas later this summer, but also Optimus robots. Like, this is a 10-year out, 5-10 year out sort of bet on Tesla. He says that it's going to be choppy this year. Auto sales will probably be down or weak because he only flicks at the issues like you're talking about, right? He's flicking at the fact that European sales are tumbling, right? This is the newest data that we have. We see protests in the U.S. We see people who are longtime Tesla owners wanting to give their cars back because they're unhappy with Elon Musk and his sort of foray into politics. So I think we see that part, that immediate effect. If you're a Tesla shareholder, your stock's down 30% this year. I don't know how you're happy about that. So I think it's more about he's like just. It's okay, hold on for a few years, but that's a lot to ask.
It is a lot to ask, especially given so much of that uncertainty, given the fact that there has been so much blowback of Musk inside the White House. Plus, let's also talk about BYD, because there was some news out, a headline out this morning, and they're looking to raise $5.2 billion, and this will be Hong Kong's biggest share sale in nearly 4 years. Also comes on the back of some pretty strong sales numbers, too.
Yeah, I think this is a good pairing here, right? So you see, we have Tesla here, sort of the bet on the long term. BYD's making sales now, had a huge month in February in China and other areas. They want that money to expand, to keep growing localized production. They're putting their self-driving tech in their cheapest cars, which is sort of a big deal. They're giving that to consumers that are actually buying those cheaper EVs. And this is like, this is them expanding. This is them expanding their actual auto business right now that's growing. People are interested in it. Whether we see those cars in the US is another story, but look, they're looking to overtake Tesla in pure EV sales this year, right? That's potentially going to happen. And I think it's a tale of two companies right now, where one is super focused on the actual here and now, and according to Adam Jonas with Tesla, they're focused on 5 to 10 years out.
All right, Pras, thanks so much. Let's take a look at Intel. There's a report out this morning that Nvidia and Broadcom are running tests on Intel's manufacturing process. This is according to a report from Reuters. The test could indicate that the companies are considering committing significant manufacturing contracts to Intel. Obviously, that would be very, very welcome news for Intel shareholders. You're looking at the stock up just about 2%. Now, Nvidia has declined to comment there to Reuters, and Broadcom did not respond to Reuters' request to comment. But Intel spokesperson is saying that, quote, they don't comment on specific customers, but continue to see strong interest and also engagement on Intel 18A across our ecosystem. And I bring that up just in terms of the fact that I think that does point to some interest, whether or not it be from these two companies, maybe more broadly speaking, throughout the industry, and obviously would be a welcome boost here for Intel's business.
100%, and this comes as Intel is still the top performer in the SOX Semiconductor Index year to date. You've got a couple of their competitors underperforming them. This would potentially be negative news for TSMC. This kind of puts Intel in direct competition with them. The manufacturing process Intel uses, it's called their 18A process. It's a chip making technology that's utilized for those advanced AI processors that TSMC is typically more known for. Intel's already got deals with Microsoft and Amazon on similar chips production that uses that 18A process. And the last thing I thought was interesting in reading about this morning is that this contract manufacturing business was a key focus of Pat Gelsinger's before he was ousted from the company. And now we're seeing that potentially being part of the company's success story moving forward. So something to continue to look at in terms of Intel stock still moving to the upside this morning. Take a look at Core Scientific, the digital mining company, reporting a disappointing fourth quarter with total revenue coming in at $94 million compared to $141 million a year earlier. Joining us now, we've got Adam Sullivan, Core Scientific's CEO. Adam, great to have you on this morning. Talk to me about the strategic decision making when it comes to investing in more of these data centers as a revenue driver moving forward, and how that might be weighing on your revenue currently, but how you see that as a growth story moving forward.
Yeah, absolutely. And thank you for having me on. This is all part of a long-term transition that Core Scientific is going for. last year, we signed over 500 megawatts worth of contracts. We followed that up, just last week with another $1.2 billion contract. So from a long-term basis, Core Scientific is in a stronger position than ever, and we're hyper-focused on continuing to invest in new locations, new geographies, and bringing new clients into Core Scientific, because this is really about a broader shift in the industry of where power is going in America. Power is going to compute. And we are a part of that trend, and we are going to be a major growth factor to help facilitate bringing more compute online for all types of use cases, not just artificial intelligence, as the news really likes to talk about these days.
Adam, is that the number one priority right now of Core Scientific? And I guess to what degree is that going to then shape how you navigate or some of those opportunities in the future?
Yeah, I mean, this is really our sole focus today, is really to continue to drive growth into this business line. Bitcoin mining provided a very strong foundation for our company early on. We were the largest operator of infrastructure dedicated to Bitcoin mining in North America. And we've been able to pivot that entire business now, almost that entire business, to building large scale data centers to fulfill this massive trend that's going on in the industry.
Adam, I know you're going to say no, but when you hear of the strategic Bitcoin reserve and see the lift in crypto stocks today, do you have any regret about transitioning as fully away from Bitcoin mining as a key cornerstone of the business?
Absolutely not. The broader trends in the data center industry right now provide for long-term contracts that provide significant amounts of free cash flow. Now that we're talking about strategic Bitcoin reserves, potentially other cryptocurrencies as well, even with Bitcoin price increasing significantly, mining economics have continued to decline over time. And that's a trend that will continue over the course of the next 5, 10, 20 years, really no matter where Bitcoin price goes. And that's because the infrastructure development, the advancements in chips really keep a ceiling on where mining economics can go over the long term.
It's an interesting comparison, and I know it comes in the context of you unveiling plans for that $1.2 billion data center expansion in partnership with CoreWeave. Why is now the time to be betting on AI strengthening moving forward as a revenue driver, especially given the questions that we're hearing about the amount of CapEx from big tech firms into AI and questions about DeepSeek that are pointing to concerns about how much people are spending on AI and training?
Yeah, I think the most important thing that we saw after the DeepSeek news was every single hyperscaler announced earnings really the following week or 2 weeks following, and everyone increased their CapEx expectations. I mean, what we're seeing is a broader adoption of AI. And really what we're seeing is we're at the very early stages of the growth trend. So we're at the very early stages of a hockey stick style growth where right now it's humans interacting with agents. And what we're going to see going forward is more AI agents interacting with each other, which is going to continue to drive further demand in this ecosystem. And so we're going to start to see this ramp significantly over time as everything we interact with on a daily basis is going to be touching a data center soon. And so that's one of the most important things to note, and the reason why we're at the earliest point in this trend that we possibly could be, because this is really going to be a 5, 10, 20-year bull cycle of continuing to develop compute and continuing to invest, especially in inference facilities, which are really some of the most necessary facilities to help facilitate your day-to-day uses and interactions with artificial intelligence.
Adam, what can you tell us just about your ongoing discussions, whether or not you're having ongoing discussions, I'm guessing you are, with some of those hyperscalers that you were just referencing, and maybe what that tells us just about Core Scientific's role here in 5 to 10 years from now?
Yeah. I mean, every hyperscaler wants to move more quickly. I think last year we saw a lot of news around one of the hyperscalers really making a big push into building big data centers. Now we fast forward to where we are today in March of 2025. A lot of the hyperscalers feel behind from where, when they were watching all of this occur back in 2024. And so everyone wants to move with greater speed. Everyone wants faster delivery, but there are massive supply chain constraints in this industry today that are pushing out delivery of infrastructure, even if you sign a contract today, 12 or 18 months out at the earliest. And so what they're trying to do right now is get all of the facilities that they want for their 5 and 10-year plans. They want to secure all those this year to ensure that they can actually meet the delivery schedules that they're promising to their end clients. Because this is really about how much market share can you capture in this industry. And for the hyperscalers, they're all in an arms race now to secure as much power capacity as they possibly can to ensure they can meet any demand that they receive from a client.
Adam Sullivan, we have to leave it there, but thanks so much for taking the time to join us, CEO of Core Scientific. Well, coming up, we're going to be taking a look at what the latest ISM manufacturing data tells us about the health of the economy. Of course, it was a market-moving report at the top of the hour. We saw stocks turn lower, prices paid rising there. A huge concern here for the U.S. economy going forward. We got much more on that when we come back.
The Trump administration pushing forward with new tariffs on Canada, Mexico, and China as soon as Tuesday, though Commerce Secretary Howard Lutnick described the tariffs as fluid in an interview this weekend. Here with more on the president's tariffs plans, Yahoo Finance's Ben Werschel. Ben, just how firm are these tariff announcements coming up on Tuesday?
Yeah, it's as firm as every other Trump tariff announcement that we've seen. I would note that these are tariffs that were supposed to go into effect a month ago, and then they got delayed by this 30-day period. What Lutnick said is that the tariffs are coming, but the rate itself is fluid. So it's sort of fluid in a bunch of different directions. What I tried to focus on today is that the kind of bottom line for the markets here is that with all of Trump's promises coming down the pipe, even if he's 80% bluster, say, that still would represent more than his entire first term. He's already implemented 10% blanket duties on China. What he's promised for tomorrow is 25% on Mexico, Canada, and then an additional 10% on China. That, if he did that and then he did nothing else, that would be far above the economic effect of his entire first term. And then that's not even talking about the upcoming. Next week we have steel and aluminum tariffs that on their own would sort of, along with these already China ones that are already in place, would match what Trump did as an entire first term. So it's a hard thing for markets to game out at the moment because Trump he's promising so much, and there's a high expectation that he'll pare it back in some form, and he's already, Lutnick is already signaling that. But even if he does, it's still sort of wide-ranging economic effects.
But is this conversation going anywhere? Are tariffs going to be something that we're talking about, not only for the next couple of months, but really years to come when you look ahead to the rest of the administration?
For sure. I mean, I think Trump, he indicated in the campaign trail that tariffs were going to be an even bigger agenda item for him this time than last time. So I would suspect it's not going anywhere. I mean, I do think we have a month here where we're going to kind of see if the rubber meets the road on his major issues. His big deadline that he set is April 2nd. That's the reciprocal tariffs. Lutnick has called that the big transaction. So if we're in a month's time and we sort of know the landscape, it may sort of fade a little bit. But I think the answer to your question is yes, that it's going to be a kind of through line of it. The question is how much he sets in place and then adjusts it over the next 4 years.
All right, Ben, always great to talk to you. Thanks so much for breaking that down.
Thanks. Talk to you later.
February's ISM manufacturing index coming in below expectations. Prices paid rising to the highest level that we've seen since June of 2022. Now, this is a sign that input costs for businesses are quickly rising. Stocks turning lower on the heels of this report. For more on this, we want to bring in Tim Fiore. He's ISM Manufacturing Business Survey Committee Chair. Tim, it's good to have you. So obviously some worrisome signs within this report. Prices paid rising. You have new orders below 50 as well as employment, both sagging below 50. What are you hearing from the business community just in terms of the macro conditions right now and whether or not it is deteriorating at a rapid clip?
Yeah, thanks, Shauna. So I think the whole story here is really around the tariff issue, which is really the prices index. Because the fact that the prices index went up 7.5 points, it's really impacted the new order levels, the inventory level, as well as the supplier delivery number. And let me explain. So our prices index really measures the width of the lake, not the depth of the lake. What this really says is that a lot of companies have been impacted by steel and aluminum tariffs. Now, I think they're 15%, 10 or 15%, but the spot market immediately went up to that tariff price per ton when the tariffs were announced, even though they don't go into place till the 12th. If you look at the spot market, you look at the Midwest differential for delivering aluminum, it's up 20+% since I last spoke with you last month. So what that has done is it's slowed down the new order rate because suppliers are not going to take new orders unless they agree with their customers about who's going to pay for this. It's also caused an increase in the inventory count because we pulled forward deliveries over the last couple of months to try to avoid these tariffs. It's also, probably some impact from the Lunar New Year stuff showing up. And it's impacted the supplier delivery number. They raised the number because some suppliers are obviously refusing to deliver their product unless there's an agreement on who's going to cover these tariffs. So the good news here is that the new order number, the supplier delivery number, inventory number are probably a blip. It might be this month. Well, we got Mexico and China coming not too far down the path here. That'll probably, if you remove the tariff issue, the one-time tariff issue with steel and aluminum, those numbers will probably recover. The prices number is going to stay elevated. I mean, that's really the story this month, is that consistent with the administration's stated goal of the External Revenue Service and its basis is tariffs, that this number is going to stay high. I would really quiver to think of what would happen if the Mexico and Canada tariffs go into place in the next couple of days and what that would mean for the PMI for March.
What would it mean?
Well, it's probably going to mean that new order number gets even worse. The supplier delivery number gets even worse. The employment number probably drops more because people are still releasing people now when they really shouldn't be releasing people now. They were much more optimistic a couple of months ago about, okay, we destaffed to the right headcount level consistent with our forecast. But given the uncertainty here driven by the tariffs and the impacts that could have on the Fed's interest rate policies, they're continuing to destaff people using primarily attrition and freezes as a tool rather than layoffs this month, which I think is it's good news. So they're not acting as drastically that they had been in Q4 of last year, and even to some extent last month. We thought the employment number would stabilize by now, but what business people are saying is, in this space of uncertainty, I don't think I'm going to carry this headcount. I'm not going to reduce my headcount proactively, but I'm going to attrit down, meaning if somebody quits, I don't want to replace them right away, and I'm only going to replace people that are strategic to the company. So, and you would expect that if those Mexico and Canada tariffs go into place, that prices number could easily be 80 plus, if not more.
So what does that tell us more broadly about risks to the economy, risks of a recession, risks of even stagflation moving forward, Tim?
Oh, well, thank you for that question. Well, I mean, if you stay on the path that we're headed on, I think it's going to be a tough route. We've been saying for a while here that the second half, when the tariff as a tool was announced many months ago, we knew it was announced. The administration's continued to deploy that strategy. If they deploy the strategy, the second half of the year is not going to look good because it's going to, first off, it's going to clog everything up. Our panelists already said back in December that their ability to pass price increases through were half as good as they were last year. So they don't really think that they can pass the prices through. So either make it up in productivity, which is only so much you can do, or you eat it and then it's a margin. So I mean, that's kind of the summary on this, is that there's no magic about this. When you raise the price of input goods, somebody's got to pay that cost, and eventually it ends up in the product that you're selling.
Yeah,
So,
Tim, you said it would not look good for the second half of the year. Does that mean recession?
I'm not sure. I don't want to call that. That's well beyond my pay grade. But I will tell you that our prices index has been very consistent for the last year and a half about what's happening with the CPI and the PPI. So when we show a weak growth in prices, you're seeing a stable CPI or a PPI. When we show a more dramatic increase in prices, think 55, 56, you're seeing maybe a 10th tick up. Now we're at the 62 level. So what does that mean to the CPI and the PPI that comes out this month? I would say it's going to go up. And then what does that mean to the Federal Reserve? You know the answer to that. The other thing here is that our new order number generally does a pretty good follow with the industrial production numbers released by the Federal Reserve. So we're now down in the 48.6. I would guess that their IP numbers for the prior months are not going to be as positive as they have been. And all that's going to weigh into interest rate decisions that may or may not change the administration's policy. The Federal Reserve can only react to what's happening. They don't proactively do things in the market to change or even to butt up against the administration's policy. So it's really up to the administration to make some decisions here that, it's nice to say we're going to raise all this money through, quote, a tax on imported goods. You saw what it did to the steel and aluminum markets, which is just an industry issue. What happens when you do reciprocal tariffs across everything? I shudder to think.
All right, Tim, a great breakdown. Thank you so much for joining us this morning to break down those ISM numbers. We appreciate it.
Thanks, guys.
We will have all of your markets action ahead right here on Yahoo Finance, so stick around for more.
Billionaire Warren Buffett speaking out on President Trump's tariff plans over the weekend, calling the policies a, quote, act of war and warning of their impact on everyday Americans. The Oracle of Omaha adding, quote, they're attacks on goods. I mean, the Tooth Fairy doesn't pay them. Tariffs on Canada and Mexico, along with additional levies on China, are scheduled to take effect tomorrow on Tuesday. The significance of this, obviously, just the fact that so many investors pay very, very close attention to what Buffett has to say, the fact that he is commenting on Trump's policies for the first time this time around inside the White House when it comes to tariffs, obviously is grabbing investor attention right now. And this also coincides with more of a bearish activity that we've seen from Buffett here, Maddie, over the last several months, as he has been raising more cash. Of course, lots of questions about whether or not maybe that true or maybe that is a sign that he is a little bit more sinister, a little bit more worried about what the coming months, quarters could potentially look like here for the U.S. economy, the impact that that could have on the stock market, or if in fact he's just raising some money following some pretty profitable investments as we do look ahead to the successor coming in here, Greg Abbott. So there's lots of questions just about what exactly is fueling some of that. But I think when you take some of these commentary here from Buffett at face value, obviously showing some concerns about the economic impact that tariffs could potentially have here if in fact they are implemented.
Yeah, I thought it was really interesting hearing him talk about how, yes, they are potentially inflationary, and he did talk about it as somewhat of an act of war to some degree, was the quote from him. But it was also interesting kind of hearing him backtrack just a little bit, because he did also say that, you know, inflation is going to happen. Like, prices are going to go up 10 years from now, 20 years from now, 30 years from now. And hearing him say that made me think, well, maybe he's not saying that tariffs are the only thing that raises prices. Maybe prices just go up over time, which we do know to be true. But I thought, as always, he came in with a little bit of good advice, saying you always have to ask the and then what question in economics. Always say, and then what? What happens after that tax on goods? And that's something that, of course, we'll continue to be asking our guests moving forward here too. Well, those tariffs on Canada and Mexico set to take effect tomorrow. So how could global businesses calibrate their trade strategies in the face of ever-changing policy from the White House? Joining us now, we've got Marissa Adams, HSBC America's Head of Global Trade Solutions. Marissa, thank you for coming on set with us. We appreciate it. Talk to me about what you're hearing from clients just in terms of how prepared they already are, regardless of what the outcome is tomorrow on these potential tariffs.
Thanks, Madison, and thanks for having me back. Corporates are really prepared around basically trade dislocation and friction in trade in general. And part of that comes from the past 4 years. So if we look back 4 or 5 years ago during the COVID pandemic, it really was a wake-up call for corporates to look at their entire supply chain, to look at where they were sourcing goods from, and to think about risk in a very different manner. So previously, if you look in the consumer retail sector, they looked at risk SKU by SKU. Thinking about the different items, versus flipping to now looking at things like customs duties, regulations, a variety of different other shipping risks. And we've seen customers really focus on a risk management framework, regardless of sector.
Marissa, just given the fact that we might not have clarity or certainty for quite some time, what does that then tell us just about how some of these companies, various sectors, are going to navigate the next several years?
Yes, so what they're thinking about at the moment, and I would say that companies are preparing. So certainly most corporates that we speak to, particularly the large Fortune 500 companies, do have situation rooms around tariffs. So I don't want anybody to think that they're sort of sitting and waiting and seeing. They may not be acting right at the moment, but believe me, the scenario planning that's happening amongst the top corporates here in the United States as well as in Europe is significant. We are working with them and partnering, and HSBC was founded as a trade bank, so our partnership with clients is very much on focusing on these disruptions. Trade disruption isn't anything new, but what we're seeing corporates do is actually look a little bit more at their business in general. So companies that I would say were typically cash rich are saying, actually, are there other working capital tools that we might need to implement? For example, on the supply chain side, are we going to be in a situation where maybe our suppliers need us a little bit more because of the potential impact of rising costs or customs duties that come along with that? So they're looking at potentially ways they can do that. On the flip side, for their buyers, how do they potentially extend terms out? So we're working with clients on how we can partner, but giving them ideas around what that might mean in an environment where potentially it takes longer to get their goods into the country, particularly in goods trade, and there's not necessarily certainty on when and how any of these potential tariffs and impacts will come into place.
And that's before you even consider impact of export controls and other potential policy that could impact some of these industries and sectors. I wonder what you're hearing specifically from tech companies that you work with. How are they preparing, especially given those potential export controls on chips that could be a big impact?
Yeah, it's a really great question. I'd say that they've been preparing for this for quite a while. So as I say, tariffs are nothing new. And what they've been looking at is how do they source some of their production in other areas. What we've seen in the tech sector, and I'd also say in healthcare as well, is that given the multinational nature of a number of these corporates, they've actually already done some pre-planning around shifting production. So healthcare clients, as an example, where they produce in Asia and they sell in Asia, we've seen that production come forward versus there's less of the back and forth in some elements. In the tech sector, we've seen that in particular areas, but as you know, it takes a long time to move supply and production, potentially 5 to 10 years to reshore or change the production element to a different area. So we see efforts that have been in place for a number of years, but some of them are being accelerated in order to bring that production closer to home, particularly in the hardware space.
All right, Marissa Adams, we have to leave it there. Thanks so much for taking the time.
Thank you very much. Thank you.
Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. President Trump reportedly expected to announce an investment from Taiwan Semiconductor later on this afternoon. According to a report out from the Wall Street Journal, the chipmaker is expected to invest $100 billion in chip manufacturing plants here in the U.S. over the next 4 years. The company announcing plans to build a chip factory in Arizona for $12 billion. That was first announced back in 2020 before expanding with 2 more factories at the same site worth a total of $65 billion. And Maddie, President Trump has talked time and time again just about the importance of manufacturing more chips here in the U.S. That has been a focal point for him. He's been very critical of the CHIPS Act, has oftentimes argued that maybe it makes more sense to do this through tariffs. But again, this has been a focal point, a priority here of his administration, trying to get more chip manufacturing here in the U.S. And of course, if this is announced later on this afternoon, this will be a first step of, I would assume, many here, just in terms of what we could see in terms of outside investment over the next 4 years.
Absolutely, especially given the focus on boosting that domestic chips production. As a reminder, we did have President Trump teasing out those 25% tariffs specifically on chips imported into the U.S., so perhaps increasing investment into TSMC building out domestic production facilities is a way to hedge against that. It'll be really interesting to see whether or not there's any movement on that 25% tariff on chips if we do start to see companies capitulating to the president and saying they're going to be open to boosting domestic production, which I'm sure they're willing to do if they're getting money from the U.S. to do that. I'm also interested in the relationship between this news, if there is any, between this news and the pledge from Sam Altman, Oracle, SoftBank to invest as much as $500 billion into AI infrastructure into the U.S. Is any of this $100 billion investment into TSMC going to be coming from that pile of money? We don't have that information at this time, but that's a question that came up for me as we're taking a look at this news again from the Wall Street Journal on TSMC expecting that $100 billion investment in the U.S. here.
Yeah, and this report also on the heels of Apple saying that it plans to spend $500 billion more over the next 4 years to expand its manufacturing footprint here in the U.S. All right, we'll keep right here on Yahoo Finance. That does it for Catalyst. But coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Stocks falling, paring back earlier gains to kick off the month of March. Intel shares higher on reports of 2 new potential customers for the chipmaker. Reuters reporting that Nvidia and Broadcom are running tests on Intel's latest manufacturing process. Intel gaining these chip designers as customers would be a huge win for the company's struggling foundry business. And crypto-related stocks like Coinbase, Robinhood, and MicroStrategy are rising today after President Trump announced a strategic crypto reserve that would hold Bitcoin, Ether, and other tokens. And shares of Chipotle are higher after Morgan Stanley upgraded the stock to overweight from equal weight. The analyst saying an entry point has opened up for buyers amid choppy demand and some structural issues. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, President Trump announced a strategic crypto reserve. We'll discuss what this means for investors in the space. And the state of student loan forgiveness has changed under the new administration. I'll talk to an expert about what borrowers on the save and income-driven plans need to know. Plus, AI is likely to change the way that we work as we know it, and an economist will share the key ways to upskill for the future workplace later on in the hour. You don't want to miss it. We've got all that and much more coming up. But first, we take a look at some of the market action. We are 90 minutes into the trading activity, and stocks wavering to kick off the first trading day of March. We were higher, now we're lower. Joining me now, we've got Veronica Willis, who is the Wells Fargo Investments Institute Global Investment Strategist. Great to have you here with us, Veronica. You are viewing the current volatility as an opportunity to reposition. And we've kind of heard this from a few strategists and portfolio managers talking about this as the great repositioning or the great rotation, if you will. Walk us through how you're doing that.
Yeah, absolutely. So we've gotten a bit of a rocky start to the year. And with this pullback that we've seen in equities, it's a great opportunity for investors to have that chance to add to equities again. All through the past couple of years, we've just seen those equities march higher, and there hasn't necessarily been a great buying opportunity for investors. So anyone who's been having cash on the sidelines, now is just a really great opportunity to get some better valuations, get a better entry point to add to their equity positions.
Where do you think the sectors that are inducing or at least attracting most of that rotation are right now?
Yeah, I think right now, with that pullback that we've seen in tech, we've seen some of those other sectors starting to benefit a little more. So financials has certainly done really well. We also like industrials right now. We like energy, and we like communication services. So, pulling a little bit from that tech, but not too much, and adding to some of those other sectors.
Veronica, the theme of the week, it seems, if this gets enacted, is the tariff man cometh, and all those things that we've been continuing to watch from campaign now to action. It ultimately raises the question of what type of impact we're anticipating for volatility tied to tariffs.
Yeah, I think we've seen a lot of market volatility tied to, the risk of tariffs. If those tariffs do get implemented tomorrow, it could contribute to a little bit more market volatility. But I do think the market has, priced in that possibility of additional tariffs already. The market's also starting to price in the possibility that inflation will be a little stickier, maybe a little bit more elevated with the implemented tariffs.
And so if we are to see that take place and inflation be a little stickier, what does that hold for the Fed, and what's the trade-off of that? Because now we're talking about potential impact to one of their dual mandates, and then additionally, we've already seen the consumer mindset say that there is a little bit more pessimism into the system with regard to business or employment opportunities right now.
Yeah, that's exactly right. So if that inflation remains a little bit more elevated, we're not likely to see the Fed cut a ton of times this year. Our base case is that the Fed is going to be able to cut rates once more this year, but that risk that they may just be on pause for a little bit longer than we're expecting is rising the more that we see that inflation number stay elevated and that weakness and that uncertainty developing in the labor market.
So let's talk about that a little bit more. Your expectations from this week's slate of employment situation data, which ultimately will come to a head with the U.S. jobs report later on this week on Friday.
Yeah, so we're thinking that the labor market is holding steady here, maybe not necessarily as strong as it's been in the past couple of years, but we haven't really started to see signs yet of any broad deterioration. If we do see that, that's going to be a bit of a shock to the market, especially with those expectations for what the Fed may do.
And so from the areas of the market that you're anticipating the most perhaps impact, especially on the employment side, we've of course been continuing to track the changes that the Department of Government Efficiency has been making in those cuts that have come forward. Do you expect that to actually roll through to this print? And what type of broader impact do you think that holds?
It may be too early to see those impacts in this print. We might see some early impacts to it. And I think in the coming months, that's when we'll really start to see those impacts filtering through in the employment numbers, especially in that monthly jobs report.
Veronica, thanks so much for taking the time here with us today. Really appreciate it. Good to see you.
Thank you.
Bitcoin is rebounding today, back up over $90,000 after President Donald Trump announced the creation of a strategic crypto reserve that will include Bitcoin, Ether, XRP, Solana's SOL, and Cardano's ADA. Joining me now on this, we've got Market Domination co-host Josh Lipton. You've been all across this one, Josh.
So, Brad, it is welcome news for crypto fans. President Trump once again talking about his plan for a U.S. strategic reserve of cryptocurrencies, including, he now says, Bitcoin, Ether, and 3 other tokens. A U.S. crypto reserve will elevate this critical industry after years of corrupt attacks by the Biden administration. Trump saying on Truth Social, "I will make sure the U.S. is the crypto capital of the world." Trump campaigned, of course, as a crypto ally and won over the industry with bold pledges, including this idea of a strategic crypto reserve. As our colleague David Hollerith does report out, it's still not clear how exactly this would work, but Trump can order the U.S. government not to sell a stash of roughly tens of billions of dollars worth of Bitcoin it has acquired through criminal seizures and other forfeitures if they are unclaimed. The government has acquired other crypto assets in a similar manner, though no one is quite sure how much in total it does hold. Congress would likely need to step in for further steps like what Senator Cynthia Lummis proposes, having the government actually buy more Bitcoin. Bitcoin did surge nearly 60% over the 6 weeks following Trump's win in November, eventually hit a record of more than 109,000 on January 20th, but the euphoria then faded and the slide started. Bitcoin is still off nearly 20% from that all-time high, though up around 15% from last week's low. The sell-off was due to different factors, broad macro uncertainty causing investors to avoid assets thought of as more risky, and that recent news of a $1.5 billion hack of crypto exchange Bybit. Still, Bitcoin bulls have been quick to argue on Yahoo Finance that there are continued reasons for optimism.
If you go back and you look at the 2017 bull market or the 2021 bull market, historically we see anywhere between 4 to 7 drawdowns of 30% or more. And so really what we're seeing is just what has always happened. Bitcoin is a volatile asset. That's what people are buying. It's buying volatility. So if you want Bitcoin to go up, you've got to be okay with it going down sometimes. And these kind of cooling off periods or these consolidations are very natural.
Now, analysts at Bernstein also recently weighing in, telling their clients that they see Bitcoin as possibly dropping as low as 70,000, but they emphasize that nothing fundamental has broken in their structural view of the current Bitcoin cycle. Bitcoin is yet to claim a cycle high, which we believe is closer to the 200,000 mark over the next 12 months, they said. And by the way, the Journal reports that Trump is expected to host and speak at the first ever White House Crypto Summit on Friday, so stay tuned for more possible headlines. Brad.
Josh, thanks so much.
You
We're
got
going to
it.
be tracking this very closely. We know you will be too. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Today, we're focused on some big retail names reporting results this week. And for that, I'm joined by our very own Brooke DePalma. Brooke, great to have you here with us to break these down. First up, we got to talk a little Target, as it's called out there. Target shares slightly higher on the day here as we're taking a look at the move higher of about 0.9%. Company had a rocky 2024. Shares ended the year lower by about 5% as it lost market share to Walmart. So what can investors expect here?
If Target has to continue to battle against this idea that consumers are flocking to Walmart for grocery and they're still pulling away from discretionary purchases. Now, as far as what exactly Wall Street's expecting here, they are expecting revenue to come in at $30.67 billion alongside adjusted earnings per share, $2.26. And get this, a slight increase in same-store sales growth of 1.18% there. Now, investors really have an eye on that continuation of an update that we heard earlier this year of a strong holiday in November and December. During those 2 months, the company said that it saw a same-store sales growth of 2% as well as traffic growth of nearly 3%. In addition to that, we know that cold weather in January could have helped pull inventory forward, but investors really keeping an eye on that 2025 outlook. Will this be the year that Target is able to regain that discretionary general merchandise same-store sales increase? Now, we know that the offset of that could be consumers doubling down on promotional items. Now, that could hurt same-store sales growth within general merchandise. We know that Target is really trying to push newness. They have that new partnership with Champion. They're also trying to push value. We know that under their wellness category, they're pushing for under $10 price points. Investors also keeping an eye out for alternative profit streams like that media business, Roundel, which competes with Walmart Connect's advertising business, and that membership model, Target Circle 360. We continue to watch out for something like that. Could that bring in new members to Target?
All right, they got some of my dollars. We also covered the big social media push for an economic blackout on Friday. Target was definitely on the list of places that people were avoiding. What can you tell us there in terms of what we're anticipating the company might say about that?
Yeah, well, keep in mind, tomorrow is not just fourth quarter results for Target. It's also Target's Investor Day. And they're expected to get questions about what exactly that February 28th boycott meant for the company. We know that results won't show in the fourth quarter because February 28th is part of the first quarter results. But this economic blackout that they called this boycott on Friday initially was intended to combat what one founder of a company, or rather an organization, called price gouging. He accused the company of price gouging. That was his initial idea, but it really got combined with that pushback to DEI because Target had pulled out of their DEI efforts. And so this is expected to be a top conversation with the Investor Day tomorrow, but we won't know exactly what this past Friday meant with that boycott and how it hit same-store sales, foot traffic, etc., till the first quarter.
We're going to be continuing to watch Target, another big retailer in focus this week. Best Buy. Shares edging lower here today by about 0.75%. Stock has had a tepid year in 2024, just single-digit move higher. And so we've got a lot of expectations for this one, knowing the pullback in some of the larger consumer electronics and appliances as well.
Yeah, exactly. That pullback is expected to be an ongoing story for Best Buy as well. We know that revenue is expected to come in at $13.69 billion alongside adjusted earnings of $2.39. But for fourth quarter, we are still expected to see that negative same-store sales growth of roughly 1.5%. Now, three things to watch for in Best Buy is this ongoing weakness around discretionary goods. Now, that's expected to be driven lower by ongoing weakness in appliances, entertainment, consumer electronics. So many investors keeping an eye on that 2025 guidance here as well. They do expect the guidance to be about 1.33%, a single-digit increase there, as this replacement cycle has Wall Street excited here. They're thinking, okay, will consumers get more laptops, more notebooks, especially as we come 4 to 5 years out from the COVID-19 pandemic. They're calling that 4 to 5 year range from Q1 2020 a sweet spot here. And also, we're really watching out for this potential tariff impact. I mean, what timing here for Best Buy's earnings? That tariff potentially going into effect tomorrow, March 4th. Also, Best Buy coming out the results. We know that in the past, Best Buy has said that price increase, that impact of tariffs will have to trickle down to the consumer. Roughly 60% of Best Buy products come from China. Mexico is their second largest supplier. And so this could take a big toll on Best Buy. We know that. We'll expect to hear from executives on how exactly they plan to offset that. Will that mean a price increase for consumers?
Yeah, the replenishment rate is low on my TVs right now. So well capitalized there. Thanks so much, Brooke. Appreciate it. Coming up, everyone, changes for student loan borrowers. We're breaking down what you need to know next on Wealth. Millions are getting ready to head out of town for spring break, just a few weeks away. While costs have gone up this year, there are still some ways to maximize those savings. Here with the details, we've got Yahoo Finance's Carrie Hannon. Carrie, first and foremost, where are you going and how can we maximize the savings?
Brad, yeah, I don't know about you, but I am ready to go. I'm definitely ready to go. It's been a cold winter. Here's the deal. Travel demand, as you said, is up. Prices are up as well, both for airfares and for hotel rooms and so forth. But Americans don't seem to care. They're like, okay, we're going, we're ready to go, and we're going to spend, more. We realize we're going to spend more this year. And so, but, there really are ways to get around it. And it's not, it's not rocket science here, but you need to be flexible, right? If you can, for whatever reason, not leave on a Friday, a Saturday, or Sunday, if you can travel midweek, you're going to find the best deals. And that's pretty hard to do when you have a school vacation or something like that. But if you have some flexibility, the other good thing to do is, one of the experts I talked to said, follow the deals, not the destination. So think of a couple places you might want to go and then set those price trackers. Most of the apps like Hopper has one, and Kayak has one, and Google Flights. Set those little trackers. So when something dips and you're like, hey, let's do that. That's a good price for me. So you really want to try to look at some of these ways. But what the experts I talked to last week said to me was that people are really heading overseas. International is big, whether it's Portugal or Spain or going to Rome, Morocco. These are spots that are in demand. And yes, of course, people want to go to Florida for spring break, right? That's a classic. So we're seeing the uptick, and it's just, if you think you're going to go away for spring break, get on it, pedal to the metal here.
Absolutely. Carrie, thanks so much. I'm going to be watching this. Since President Trump won the election in November, there have been several changes for student loan borrowers. Just days before leaving office, President Biden issued his final round of student loan forgiveness, saying the former president approved a total of $189 billion in forgiveness for over 5 million borrowers. However, Biden's Saving for a Valuable Education, or SAVE plan, is facing legal setbacks. On February 18th, an Eighth Circuit Court decision ended both the Save and the Repay programs. It also blocked 25-year forgiveness in the Income Contingent Repayment Plan, or ICR plan. That leaves the 8 million borrowers who signed up for the Save plan in interest-free forbearance. Days after the court decision, the Trump administration removed access to the online application for both the Save plan and the income-based repayment plans, writing, quote, "A federal court issued an injunction preventing the U.S. Department of Education from implementing SAVE and parts of other income-driven repayment plans. As a result, online loan consolidation applications are temporarily unavailable." Here with more, we've got Mark Kantrowitz, who is the student loan expert and author of How to Appeal for More College Financial Aid. Mark, where does this latest action leave borrowers?
Well, it should be a temporary suspension of the applications for income-driven repayment plans and loan consolidation. The U.S. Department of Education has told the loan servicers that they should stop accepting and processing these forms for the next 90 days. And that's actually similar to something that happened during the Biden administration when they had a similar issue with having to change the forms that are used to accept choices of income-driven repayment plans. So,
Mark, we're going to try.
It should take them a few months to remove SAVE plans from this.
Mark, do you have us?
Yes, I hear you.
Okay, all right. Sorry, you were breaking up there for a quick moment. Just to let you finish your answer to that question with this additive thought, what actions can students take, or borrowers right now take?
Well, there's nothing that a borrower can take to get into an income-driven repayment plan if they're not already in it. If they're experiencing financial difficulty, they should look into the economic hardship deferment, unemployment deferment, and general forbearances. The only repayment plans available to them are standard 10-year repayment, graduated repayment, and extended repayment until the Trump administration restores the form.
And so, for people who are trying to figure out remedies or alternatives, are there other plans that student borrowers can sign up for?
Well, and there's standard 10-year repayment, extended repayment, and graduated repayment. Extended repayment will probably have the lowest monthly payment unless the borrower graduated very recently, in which case graduated repayment may be barely above interest only.
Understood. So what are some of the other actions on student loans that Republicans have talked about that we might see activated, and how borrowers and students who are even just preparing financially for college, how they can start to think about what might be coming down?
Well, the Republicans are going to need to balance out the tax cuts, the extension of the Tax Cuts and Jobs Act of 2017 and other new tax cuts with savings elsewhere. And they have a menu of items for budget reconciliation that include getting rid of the Grad Plus and Parent Plus loan, getting rid of the student loan interest deduction, eliminating the subsidized direct Stafford loan so that the borrowers will still be able to borrow the same amount. It will just be entirely unsubsidized. They previously got rid of it for graduate students in 2012. They may add risk sharing for student loan defaults so that the colleges will have to pay part of the amounts of the defaulted student loans. And there are a variety of tax credits for education, like the American Opportunity Tax Credit and the tax-free status of qualified scholarships that may go away.
So as we're thinking about all of these changes, there have also been rollbacks in terms of the number of people that are working and the workforce at some of the colleges and universities that have and get federal funding. In the face of some of the rollback of some of those funds, how does this impact those who are repaying to universities or currently going to some of those universities as well, if at all?
Well, the cuts in overhead for the NIH and NSF grants, which can be severe at some colleges, that may affect graduate students because the faculty researchers fund the graduate students out of those grants. So you may see some colleges halting enrollment of new graduate students or halting enrollment of new hiring of new postdoc. So that may make it more difficult for graduate and professional students to pursue an education. If you are working for the federal government and your employment was eliminated by DOGE, or you've been impacted and lost your job at a university, that can affect your ability to get public service loan forgiveness. You have to be working in a qualifying job while in one of these income-driven repayment plans. So it's important to get a new job in a qualifying job or multiple part-time jobs that are qualifying jobs so that you continue to qualify, your payments continue to qualify for income for the public service loan forgiveness. And qualifying positions include not just working for the federal government, but working for state, county, and local governments, working for the military, and working for a tax-exempt nonprofit organization like a 501c3 organization.
Mark, thanks so much for taking the time here with us today and really laying out some of these changes that have come forth. Appreciate it.
You're welcome.
Coming up, have you filed your taxes yet? If not, our next guest recommends you do so right away, and we'll tell you why next on Wealth. 2 hours into today's trading session, let's get a check of the markets right now. We're taking a look at the U.S. major averages right now, and the theme right now seems to be intraday searching for direction. Take a look at some of the bounce lower that we've seen, unfortunately, here as we're now at intraday session lows for the Dow Jones Industrial Average right now, down by about 0.25%. The NASDAQ Composite, let's take a look at that. Started off today in positive territory, but now has swiftly moved into negative territory. Much of that in the red for the tape activity for the NASDAQ. And let's also check in on the S&P 500. That has had its own kind of waffling activity in and out of gains and losses. But as of right now, you're seeing us still not quite at intraday session lows, but in the red as of right now, down by about 0.3%. One of the factors could be the volatility that we're seeing continue to play out right now. Take a look at the SIBO volatility index, the VIX as we know it, as that fear gauge index sits still above 20 here. Just to put some more context on this, over the past 5 days, we're not quite at the highs that we've seen over that period. That would have been last week at the tail end of the session, but ultimately still hovering above that and near that 20 range. That is still more outsized. Compare that to the broader 52-week where we've only had a few spikes that have really moved us well past that 20 marker, that 20 gauge here. But ultimately, that's exactly where we're sitting. A couple times that we've ultimately breached that level, and as of right now, we're still sitting above 20, and we'll see how that continues to impact the minds of investors that want to see just what's taking place quickly within the sector activity as of right now. Taking a look at a relatively split picture, as split as you can get for 11 sectors here, but we do have 6 of them in positive territory, it seems right now, where real estate is leading the pack. That's up 0.9%. Bringing up the caboose, though, on this down day for the U.S. major averages, as of right now, intraday, energy is leading the decline. That's down by about 0.8%. And we'll ride out with a quick look at the NASDAQ 100, some deep red, lake red, if you will, on Nvidia. That's down by about 4% here on the day. And that part of a larger pullback that we've seen even post earnings. I'll put this on a 5-day view, and that should give that earnings context into view as well here, as that was last Wednesday. All right, we'll continue to track all of this and much more, but switching gears here. According to the Internal Revenue Service, in 2024, taxpayers were split, with nearly half waiting until March to file their tax return. And if you're one of them, no worries. We've got an expert on deck to make sure that you don't miss out on a single cent of that refund. Joining us now, we've got Andy Phillips, who's the H&R Block Vice President of the Tax Institute. Andy, great to have you here with us. You highlighted 3 changes that taxpayers might not be aware of. So let's start with the 1099K income. What's changed there?
Hey, Brad, good to see you again. Thank you for having me back. So like we talked about back at the end of January, probably the biggest tax law change for this tax season is around the form 1099K. So this form is used for a few things, but people who are impacted are folks who are selling maybe goods or services through an online platform, like maybe an Etsy or something like that, or who maybe provide in-person services, but take payment through a third-party payment app like a Venmo or a PayPal. So the threshold to receive a form 1099K went down drastically from 2023 to 2024, from you had to have over $20,000 in transactions, or at least $20,000 in transactions, and over 200 transactions during the year. For 2024, went all the way down to $5,000, and you just have to have 1 transaction. So what that means for this year is a lot more people are getting Form 1099Ks, and a lot for the first time. So the questions are, as you can imagine, what is this? What do I do with it? Is the full amount taxable? You know, the tip there is often with 1099 forms you file with tax forms, no, it shouldn't all be taxable. So you want to make sure you're taking advantage of any deductions you can take to offset that income. But that's definitely been a big early season driver for us. People having questions, understanding what it means to their taxes.
And so what about 1099DA income? What are the changes there?
Yep, so that one's more on a look forward, but starting in 2025, those folks that invest in virtual currencies, think of Bitcoin and other cryptocurrencies, a lot of times in the past, you may not have necessarily gotten a 1099. Some of those platforms did, but not all of them did. And so starting in 2025, meaning for your taxes next year, for those virtual currency transactions, they're going to be required to issue you a new form called 1099-DA. What's important to remember for both that DA and for the K is not only do you get that form, It also means the IRS gets a copy of that form, and in most cases, your state will as well. So they're going to know about it. And so sometimes people don't always understand that those crypto gains and losses need to be reported and can be taxable if you have a gain. So that'll be a big change going forward.
And for taxpayers with children, how has the child tax credit changed?
Yeah, so that child tax credit, is really just an inflation adjusted amount where the child tax credit is $2,000 per child, but a portion of that is refundable. That's called the additional child tax credit. What that means is even if you don't owe taxes, you can get some amount of that $2,000 to create or increase your refund. So last year it was $1,600 that was refundable. For 2024, it was $1,700. So that isn't necessarily driving the questions, but I'll tell you, questions around family, questions around life changes, like, hey, I have a nephew living with me. We're seeing a lot of questions around education this year. Where that often comes up is you have a child going off to school for the first time. And so you don't know the rules yet. You need to understand, what does that mean? What credits may you be able to take, like the very valuable American Opportunity Credit? A couple other situations where we're seeing quite a few questions about education credits and other benefits is one, people that go to grad school. Because once you get out of your undergraduate degree and move to grad school, the rules are a little bit different. And then people that are adults going back to school and understanding what they may be able to claim.
Why do you recommend filing early? And we asked this question because there have been a lot of changes and prompted by the Department of Government Efficiency, where we know that there have been federal layoffs that have also taken place here that have impacted the IRS. Why do you recommend filing early this year?
We're in March, so you can still file earlier than April. But what I would focus on is a couple things. First, file as early as possible. If you're due a refund, your return's going to get processed more quickly the sooner you file, and you're going to get that refund distributed to you. Another thing to think about is when you submit your tax return to the IRS electronically, your Social Security number is then locked. No one else can then use your identity to file a tax return with IRS electronically. So it effectively locks out like an identity thief or a threat actor who has somehow gotten your information through, sadly, one of the breaches we continue to see in the news, large scale breaches across the country, across the world. A little bit on that, though, on those questions around what do these changes mean? What do these mean to filing taxes? One, the rules haven't changed. The rules have not changed. Whether you're due a refund or you owe taxes, unless you get an extension, taxes are still due April 15th. Obviously, the incentive is clear. If you're due a refund, we see the IRS continue to process returns, continue to issue refunds, and we expect that to continue. That said, if you're filing, make sure that you're doing everything you can to follow the happy path in the processing of your tax return. File electronically. Avoid any mistakes that may result in a human having to touch your tax return, because it's foreseeable if you don't follow the happy path, meaning a human has to intervene in the processing of your tax return and your tax refund, you may see a delay. Likewise, for those people that are due, that have a balance due, you still have to pay that. The laws are still in place. And so don't think that there's some magic way that you're going to get out of that. In fact, even if you request an extension of time to file past April 15th up until October, that's only an extension of time to file. It's not an extension of time to pay. So if you're one of those folks who's going to request an extension, that's okay. But make sure you calculate and make a payment of what you expect to owe to avoid any penalties and interest, which the IRS will begin to, kind of impose against your liability starting after the due date.
I have to hustle to my finish here, but just very quickly while we have you here, Andy, any last minute changes that you can make still before you file?
Yep. I'll hit three real quick for you. One, for folks who have a traditional IRA, you can still, up to the due date of your return, make a tax deductible contribution to your IRA. There are limits on that. You can contribute generally up to $7,000 per year, an extra $1,000 if you're 50 or over. That can be impacted by things like maybe your income level, whether you or your spouse are covered by an employer's plan as well, and your income. Second one, I'd say, if you participate in what's called an HDHP, or a high deductible health insurance plan and you have a health savings account, you can still make a contribution up to the max amount, up to the due date. Again, you can deduct that and reduce your tax liability. You want to make sure you're counting any contributions you made during 2024 by you or your employer to make sure you don't exceed your contribution limit, but that's an option. One last one, at the state level, many states, if you're saving for your child or someone's, let's say your child's education using a 529 plan, a lot of states will allow you to make at the state level a tax deductible contribution to that HSA, again, up to the due date, reducing your state tax liability. I live in Kansas. We have that benefit. And here's what's really cool. You don't necessarily have to participate in a 529 plan offered by your state. I participate in one from another state based on the advice of financial advice, but I still get that tax deduction on my Kansas return.
Andy, great to have you here with us. Thanks so much. Appreciate it.
Thanks, Brad.
Coming up, AI transforming the workplace. We've got tips to help you improve those skills no matter what industry you work in. That's next on Wealth. AI proficiency is becoming a necessity in the workplace. According to a report from Udemy, demand for AI skills nearly quadrupled in 2024. That's up 291%. Joining me now, we've got Misha Fisher, who is the Udemy economist. Misha, great to have you here with us. This data highlights a growing need for AI literacy. So walk us through what this means for the evolving job market.
Thanks, Brad. It means a couple of things for the evolving job market. The two big narratives coming out of this report are, first, like you showed, in the last year, we've seen a near quadrupling in demand. That's really telling us that this is not a one-off flash in the pan result just from the release of ChatGPT. People are realizing that these are real productivity boosters. The second big report the second big takeaway that's coming out of it is that it's not just limited to the tech sector. That's where we started talking about this at first. But if you look just in the last quarter, government course consumption's up just about 10%. Transportation as a sector is up about 11%. Manufacturing is up 50%. And then in finance, we saw just in the last quarter a 75% increase quarter over quarter in demand for these things. And what that's telling us is that if you're working in these sectors, you have to be very intentional and think through your productivity that you individually deliver and also the productivity that your team delivers, and recognize that these are tools and skills that augment those things and make you more competitive and make your team more competitive.
You know, as we think to this shift and think about the productivity, I can't help but almost kind of relate it to the era where you were only as strong as the pivot tables that you were able to create in Excel or the macros that you were able to make sure were all interconnected. This seems kind of similar to that. So is it almost like you'll only be as valuable or as productive as some of the prompts that you're able to create with AI? And how can people go about making sure that the prompt knowledge that they have is also translatable to what an organization needs?
Well, you really covered the two most important parts of that. So the first is, yes, it absolutely maps to this early story that we saw around computers. It's easy for people to forget that knowledge workers as a class of workers have existed long before we had computers. Things were just done with typewriters. They were done with slide rules. Then in the 80s and 90s, we saw a real expansion of things like spreadsheets, which of course led to the pivot tables you alluded to. These were real productivity boosters. It wasn't until the late 2000s that we even saw the phone-based portion of work-based productivity come into play. And so if you are working in those things, what we saw when these technologies were introduced was an expansion of demand for knowledge workers because people were more efficient and able to produce more. But if you were not on top of that, you might not have seen the career trajectory that you would have expected before the introduction of those tools. So you do have to make sure you have those skills. And you also mentioned the very important word, translate that into the business need. Yes, that is a huge part of this. These tools are interesting and they're fun and you can play around with them on the weekend. But in the end, what a company needs is for you to be able to boost efficiency, boost productivity, make your products better, make your company stronger using these tools. And you really need both sides of that equation. You need the skill set and you need to be able to map them.
As AI skills become essential, what can job seekers and professionals do to stay competitive then?
So as a job seeker or as somebody who's currently in a area where they just want to make sure that they're protecting themselves from downside risk in their employment. We've seen a slew of layoffs across sectors. That is certainly something that I think is front and center of people's minds. It's a 5-step process. So really think through this. So the first is build that literacy. Really learn the fundamentals of what you need to know about the tools generally and also specifically about your industry-specific application. The second is actually put that into use. Apply it in your daily work. If your company doesn't pay for it, you can pay for most of these tools for a pretty nominal monthly fee, or of course, there are some free tools available as well. So get that practice. The third is this issue around signaling. If most university programs, if they had one, to run through an undergraduate degree takes 4 years. Grad school takes 1 to 3. The tools aren't even that old. So it really is about those third-party certifications that you can find available. And those certifications are very useful signals that you've learned something, that you've put the time into it. Knowing the skill itself is half the battle. The other half is making sure that employers know you've learned the skill or that hiring committee knows you've learned the skill. So you have to do that as well. The fourth is recognize that this is not the only thing. You still have to be able to communicate, to persuade, to build trust. Those are all universal human things that are valuable across industries, across careers. You really want to make sure that you're developing those soft skills alongside the AI and that you can apply a critical reasoning to the results. If you think about it, in most hiring situations, if you're looking for a job, the hiring review, certainly in tech and probably in other sectors as well, is probably not going to want you to fire up ChatGPT or some other competitor program in the middle of your interview. So you still have to be able to show that you can think. And then the final one is just stay engaged, right? This is a constantly evolving landscape. So you want to really develop the mindset of continuous learning.
Just very quickly, and I got to sprint to the finish here. What does this all mean for wages and the recalibration of the value payout and compensation?
Usually what technology does, and I have no reason to suspect that Gen AI tools are going to be any different, is it increases the variance. If you can use these things, you are more productive, you're more valuable, your wages will go up. If you don't stay on top of these tools, you will become less valuable to employers, and you shouldn't expect to see the same sorts of wage gains.
Misha, a lot to consider here with this conversation. Appreciate your time and breaking this down for us.
Thanks, Brad.
We've got much more wealth coming up after the break, everyone. A brief programming note, the money behind esports is ever growing, even more so for the young competitors. PlayVersus CEO John Chapman joined Ross Mack on Financial Freestyle to share the big financial opportunities in the sector and what it means for their careers too. Let's take a listen.
Some of our best players in the country, they can just start playing the game and streaming while they're playing. And if they've got an engaging personality that creates an audience following, that all of a sudden becomes a platform and an audience that they can monetize and, grow a small business off, and maybe even a substantial business off of it as they grow. And so one of the things that we try to do, and we're going to do more of it going forward, is making the kids who participate in our community aware of those opportunities. A little bit of a, what's a playbook on how you could get there, how you could, develop that streaming audience, and how could you ultimately monetize it.
For more Financial Freestyle, tune in every Monday, 12 p.m. Eastern Time, or on Yahoo Finance, or wherever you get your podcasts. Costco is set to report its fiscal second quarter earnings later this week. We're taking a look at the history of the wholesale giant in this episode of Beyond the Ticker.
Costco set the precedent for membership-only models back in 1983. But what led to such success for the more than 40-year-old retailer? Beyond the Ticker takes a deep dive into the company's biggest moments. Back in the 1970s, entrepreneur Sol Price opened the first ever wholesale retailer under the name Price Club in Southern California. In 1983, Jim Sinegal and Jeff Brotman opened the first Costco warehouse location in Seattle, Washington. A year later, the iconic Costco hot dog was introduced. With the fixed price point it still has today, $1.50. In 1985, Costco went public at $10 per share. At the time, the company had 17 locations. In 1993, Price Club and Costco merged. And until 1997, it was called Price Costco, until it took on the name we know it as today, Costco. In the mid-90s, Costco introduced its private label, Kirkland Signature, named after its original headquarters in Kirkland, Washington. That business now worth $56 billion. In 1997, the company launched its e-commerce platform, Costco.com, bringing its low prices and services online. By 2014, Costco was the third largest retailer in the United States, with sales exceeding $110 billion and a net income of over $2 billion. And its presence and loyal membership-only model keeps growing, giving it the ability to raise its membership in 2024 for the first time since 2017, from $60 to $65 per year for 3 of its membership models. As of 2024, there are nearly 137 million members and 891 stores across the globe.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Market Domination starts at 3 p.m. Eastern Time.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Stocks off their earlier highs following weak ISM manufacturing data. President Trump and Taiwan Semiconductor are expected to announce a $100 billion investment in the United States, according to the Wall Street Journal. Under the plan, the chipmaker will build cutting-edge manufacturing plants across the U.S. over 4 years. Shares of TSMC ticking slightly lower off of broader sell-off here. Meantime, defense stocks rising after the EU commits to boosting military spending. This follows a meeting between President Trump and Ukrainian President Vladimir Zelensky on Friday over Russia-Ukraine war negotiations. And shares of grocery chain Kroger lower after its CEO stepped down following a probe into his personal conduct. Kroger's lead director, Ronald Sargent, will step in as interim CEO. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below, where you can track the best and worst performing stocks of the session.